এটা প্রবলেম আছে কি করে টেস্ট করছিলেন
Hello, hello. Hello.
जो भी बोलो कुछ भी बोलो और साउंड बोलो बोलो नहीं
अनुष्मिता, tell.
टेस्टिंग है
Start
टेस्टिंग
testing. Hello. Continuously बोलो.
टेस्टिंग
Hello.
कंटिन्यूअसली बोलो
Continuously कुछ बोलो. Testing हो रहा है. Hello. Good morning.
अरे तो कोई नहीं कौन और वही
Akshay, can you say something over there? Testing हो रहा है.
हाँ
Continuously कुछ बोल. Testing हो रहा है.
शुभ्रा शुभ्रा
Continuously.
Testing, 1, 2, 3.
Good morning. Continuously बोलो कुछ.
अरे यहाँ पे जो लिखा है पढ़ो
School of Commerce, Affiliates Association with Affiliate Classified Business, 2022, the annual business conclave, Finance 6.0 is the theme, changing outlook. We have a perspective view and we come to this conclave. We have a lot of government speakers present today, organized on 17th and 18th of October. It's going to begin
10
again.
मिनट पौड़े आसे जितना तार किस को बाहर.
बड़ी जोर से करो
देखो पहले
A very good morning, everyone. On behalf of Infinites, the Finance Association of the School of Commerce, I, Anushmita Ghatak, a student of Master of Business Finance, School of Commerce, extend a warm welcome to you for the annual Business Conclave, Privitti 2022. I would like to acknowledge the presence of some of our eminent guests. Today, we have with us our respected Dean, School of Commerce, Professor Dr. Pradyum Kumar Mohanty, respected Associate Dean, Professor Dr. Sivanjan Mishra, esteemed industry dignitaries, our faculty moderators, other faculty members of the school, respected guests who have joined us today for the event, and the students from undergraduation and post-graduation. I take the privilege of welcoming you all to this grand event. Privitti is the annual business conclave of Infinites, which brings together illustrious leaders from the field of finance under one roof to discuss the current trends in finance, generating, engaging, and unique insights for the young minds. Over the years, we have had the privilege to interact with the best in the industry and gain a lot from the plethora of knowledge and experience they bring. In an attempt to carry forward that legacy, we have come up with yet another topical theme this year. The top theme for this year's conclave is Finance 6.0, Changing Outlook. The waves of disruption are taking over and transforming the world immensely. From blockchain to artificial intelligence, fintech to cryptocurrency, and cashless payments to total automation. The world is moving forward exponentially. In the face of such significant transformation, the financial and banking world needs to be approached from a new perspective. In the pre-COVID crisis, we were looking at Finance 4.0. This has quickly accelerated into building Finance 5.0 as the industry is now growing and changing exponentially. The old rule book has been replaced. We are now going forward to the foundational principles of Finance 6.0, where the core utilities are seamless, contextual, behavioral, and ubiquitous. To understand the underlying dynamics of the changing shape of the future finance, we have eminent speakers divided into two panels to deliberate on pertinent topics under the theme. We are very grateful to esteemed speakers for joining us today despite their busy schedules. We'll get to know our speakers better as we proceed toward the panel discussions. I now invite respected dignitaries on the dais and our esteemed guests to mark the beginning of this year's conclave by lighting the auspicious lamp that symbolizes knowledge and wisdom. I request the guest speakers, Dean, Associate Dean, CAS officers, and faculty moderators to come to light the lamp. Thank you all. I would now invite Dean of School of Commerce, Professor Dr. Pradyum Kumar Mohanty, to welcome the dignitaries by felicitation.
Now, I, Charles Markey, a student of Master of Business Finance, would kindly request Professor Dr. P.K. Mohanty, Dean, School of Commerce, Exide University, to please deliver the welcome address.
respected guests, Mr. Nitin Desai, Vice President, Morgan Stanley, Mr. Kumar Vivor, Senior Vice President, Press Vista, my dear faculty colleagues, members from the media, the team in Phoenix, members from the Career Advisory Services, Professor Sabita Mohanty, Ms. Jigisa Das, and my dear students. I must congratulate the team in Phoenix for conducting this business conclave on the theme Finance 6.0, Changing Outlook. The topic is apt because the finance world is ever changing. And the changes are happening due to a variety of reasons. Not long ago, in 2007, the world of finance suffered due to an economic crisis. That was not predicted. COVID happened in 2020, 21, for both the years we suffered economically and in many other ways. That was not predicted. But now, another economic crisis is coming. That is in the offing. And that has been predicted by many organizations, including the IMF. Last week, if you remember, it was the IMF chief, none other than the IMF chief, said the economic crisis is imminent. And you all know that the economy world over is slowing due to, again, a number of reasons. But the survey that was made recently across the globe, including our CII, that is a positive outlook expressed by the business leaders. The business leaders have said that though the economy is not growing as expected, it will grow, and there is a better tomorrow. There is a better economic, so far as economic issues are concerned, there will be a better economic environment in the coming 3 to 5 years. But this economic crisis that we're talking about has been predicted. So what is happening in this world? What is happening in this finance world, rather? We are more concerned about the finance world, as all the finance professionals are here. These events, such as economic crisis and COVID, has forced us to think the way we do our business. They have forced us to think the way we manage our business, manage our finance. And corporates across the globe are going to adopt new business models in order to survive. They need data, and data have to be analyzed. So digital transformation is taking place in a significant way, and that has affected, in a positive way rather, that has affected all the business houses across the globe. We are going to, the finance world is going to deal with a new class of assets, that is cryptocurrencies. So the digital assets, how to deal with them? Our government is not permitting yet, but they're going to come with a framework within which we'll have to operate. They're going to issue the e-currencies. So things are changing, and changing in a fast way. We also have to keep in mind the environment. We also have to keep in mind the sustainability. Sustainability is a buzzword nowadays. Companies are reporting on their sustainability issues, sustainability affairs. Companies are going to report on the governance issue. So the ESG capabilities of the companies have to be enhanced. Companies are working on them around the clock. But in coming years, that will find more importance. Are we ready for this? The biggest question before us, the finance professionals, is: are we ready for this change? Change will always happen, as we have mentioned, changing outlook. The landscape is changing, the finance landscape is changing, and change will happen. Change is the only constant. Are we ready for this change? Because this change will bring many more opportunities. Are we ready to grab those opportunities? For this, the answer is known to everyone. And the finance world always says that there is a shortage of required skills. So coming years will be for those people who possess those skills, those skill sets. So in this program, we are giving some inputs we are giving in the classroom, but we have to learn from the experts, from the finance experts, from the corporate leaders who come time and again, and they tell you many more innovative things. Innovation will always take place. Unless we innovate, it will be difficult to survive. So this 2-day business conclave, this 2-day event, we are going to learn, unlearn, and relearn from our corporate leaders. There are many important topics which have been designed, carefully thought about those topics. The experts will deliberate. I'm sure everybody, when I say everybody, we all will immensely benefit from those discussions. So let us participate in this 2-day conclave in an open mind. Let us try to understand what is happening and what will happen. Then only we can meet the challenges of tomorrow. So with these few words, I welcome once again all our dignitaries for day 1. We'll be having discussion, and I'm sure those discussions will be quite inspiring and will give us food for thought. Thank you. Thank you very much.
Thank you, sir, for enlightening us with your words. You have always been a pillar of strength and support for us. I would now like to ask Professor Sanita ma'am to share a few words with us.
Morning, everybody. First of all, warm welcome to all our esteemed guests, and we're very grateful that you have been able to take off time from your busy schedule to join us today. This, as Professor Mahanti mentioned, this is an annual event, and we use this as a forum to provide learning to all our students, all of us, and we definitely look forward to very active participation from everybody. And to the students, my message is that you ask as many questions as possible, so that you're able to get to know what are the ground realities. You are being provided inputs in the classroom, and this is an opportunity for you to make the best of getting to know what is happening on the ground. I wish the students and the organizing body all the very best, and I'm sure it's going to be a great success. Thank you so much.
Thank you, ma'am, for joining us despite your busy schedule. Now, I welcome the student coordinator of Infinix, Akshay Dev, to deliver the opening address.
Thank you, Charles. Good morning to one and all present here. My name is Akshay Dev, and I would like to begin by providing a wonderful quote by Benjamin Franklin. He once said that the best investment you can make is an investment in knowledge. I thank you all for coming here today. It shows your enthusiasm and dedication to learn new things. I would like to welcome our guest speakers who have taken the time and agreed to share their vast experiences with us. Not only will the knowledge shared during this discussion help our students gain a practical insight and make them industry ready, but it would also help sharpen our finance acumen. Today marks our first offline conclave in the last 3 years, and I am honored and delighted to have the opportunity to welcome you all here today. Before we get started, I would like to take a moment to appreciate all the people who have contributed to making this event possible. RD, associate dean, beloved faculty members, the entire career advisory team, Team Illuminatics, the media and PR cell, and Team Infinix. It would not be possible to have this conclave without your sheer dedication and constant support. So on behalf of everybody, I thank you. And let the learnings begin. Thank you.
Thank you for your thoughts, Akshay. I thank each one of you for your valuable time and for joining us to mark the beginning of today's event. We shall start with our first panel discussion for the day. To throw light on the future aspects of finance functions, we have two eminent industry leaders with us today as our panelists. This discussion will be moderated by Professor Dr. Shivanjan Mishra, School of Commerce, Exide University. I request you to take this session forward, sir.
I would first like to invite onto the dais Mr. Vibhor and Mr. Mitesh to join me in the dais, please. Good morning to one and all present here. At the outset, let me again thank our eminent panelists for finding time for us from their busy schedules. Thank you so much, sir, for being here with us today. In this session, we have two interesting topics, interlinked topics. First, shaping the future of investment banking, and second, private equity road ahead. But before we delve deep into these topics, these complex finance functions, let me put across some interesting questions before all of us to ponder upon and think before as the discussion goes on. What's Finance 6.0? Have you ever clicked Google searching Finance 6.0? You'll get nothing. Is it an illusion that we are looking forward to in the field of finance? Again, the answer is no. What that illusion is will turn reality one day. And we at School of Commerce, the team MBF, the team UG Finance and Accounting Group, as well as other researchers in our team of faculties, we are reimagining a finance function in new process ecosystem with features like cyber hygiene, decentralized finance, voice banking, and product innovations like ESG index, climate bonds, transition from global LIBOR to state rates or domestic rates, And the question we put before all of us, is this shift evident? Are we moving towards that shift? In order to move and embrace that shift, are we ready? So this is just opening up our thoughts on what will be the finance function in the next century. All finance enthusiasts in this hall will agree that finance as a domain is evolving. Its processes, products, environment, technology, all are evolving. These things are more discussed when we are struck by a crisis. Dozens of conflicts post-crisis takes place. Pondering upon the evolutions, we start evaluating whether the innovations that occurred were disastrous or useful, and so on. So we are amazed, as our student anchor highlighted at the beginning, that we are in the domain of disruptions and we are changing. So what are the new things we are encountering in this century or in the past decade? Cloud computing, robot trading, analytics, cognitive technologies, blockchains, cryptos, ESG indices, sustainable finance, all these are buzzwords now. Are we ready? Do we understand that? Are we ready to go and move ahead in this space? Amidst this disruption, the financial system across the globe are striving to respond to these changes increasingly. Post-COVID, post-COVID and the Ukraine crisis, this calls for all of us to think about or invent new attributes and mindsets which will adapt ourselves to the new ecosystem in the future years. I'd like to quote, as it is evident now till this point, that we are embracing change. And I like to quote here, change comes to those who wait, but it's the ones bringing the change who are in the full control. So as finance leaders of futures in the current business environment are expected to play a major strategic role in the businesses by creating added value, influencing business decisions beyond transitional and manual finance functions. The leaders of today are embracing technology, supporting seamless financial operations, and are providing meaningful and insightful things in the finance-related data. Although it's difficult to predict what percentage of this new ecosystem will survive going ahead, or how much will die, what percentage will die. That question is before all of us. As new businesses comes up, as new startups coming up, as new business structures coming up, the business models coming up, the existing companies are turning obsolete. They are trying to innovate, and that innovation has to be in a 10x kind of innovation. With these intriguing questions and change being inevitable, let's head towards the sub-themes of this panel, basically the shaping the future of iBanking and the private equity road ahead. To the benefit of all our students and audience and faculties from other domain of business, let me introduce you to the world of investment banking. Investment banking operates specifically in three main areas. That's investment banking division, sales and trading, and the asset management space, with primary objective of offering executives their strategic advisors. They often advise executives about the best times to make a public offering, sell a large company asset, or acquire another businesses. A primary advantage for accessing these services of an investment banker is relationship and contacts that an established investment bank can offer to its clients. In one of the recent reports by Deloitte titled Bank of 2030, the future of investment banking, it highlights investment banks are facing challenges driven by COVID-19 impacts, evolving financial regulations, market democratization, increased client sophistication, a shift to remote working arrangements, and rapid technological advances. Hence, it will be interesting to hear from the expert that how are iBanks optimizing the use of financial technology, data, and analytics to generate differentiated insight and added value post-COVID. I also, at this point of time, want to make all of us think and to reflect, we have our panelists with us. We would like to go ahead and hear from them about another specific frontier of investment banking. We anticipate that investment banking will transition from full-scale service model to a bifurcation of two broker archetypes. One, the client capture, one as treated as they are the client capturers and specialize in the front office functions, and next, the flow players that focus primarily on middle office functions. These archetypes will likely operate with an interconnected, increasingly global and potentially virtual ecosystem that includes partners, collaborations that provide various back office functions. Industry realignments should create opportunities for investment banks to drive towards higher level of returns. However, to deliver on this agenda, organizations can no longer tinker around the edges. It's likely that many will need to dramatically retool their current business models and operational platforms to prioritize client centricity, disruptive technologies, regulatory recalibration, and workforce and workflows evolution. In addition, they should determine which archetype they want and are able to be within the new ecosystem. Let me highlight on the connected flow model a bit. It consists of a simplified, agile, client-centric operating model that augments a financial institution's capabilities with those of a partner ecosystem, creating cost efficiencies by standardizing and centralizing provisions of non-differentiated services across the industry. Leveraging internal and partner data generates insight to optimize performance across revenue and cost drivers and targets financial resource use of most valuable activities and clients. Hence, we are moving toward, or we are embracing technology modernizations, workforce of the futures, client centricity, and regulatory recalibration. On this backdrop, we would like to hear from our expert panelists. Thus, without much delay, I would like to call upon Mr. Mitesh to enlighten us with his thoughts on the iBanking space. But before it, I want all of you to know who Mr. Mitesh is. A chartered accountant with 18 years of experience, Mr. Mitesh Desai holds positions in financial accounting and reporting, covering areas like controllership, risk, treasury, audit, and management reporting. He is currently the vice president at Morgan Stanley. His previous engagements with Mizuho Bank, Standard Chartered Bank, and JP Morgan. He loves reading, playing table tennis, and cricket. These are his interests, along with finance. Please, sir.
Request our Dean Professor Dr. P.K. Monty to kindly join our guest speakers in the dais.
Hello everyone. Good morning. Thanks for the introduction. And it's an absolute pleasure and honor to be here. I'd like to thank the Infinix team, the CAS team, and Exam University, and the respected faculty members to have me here. I think it's a great opportunity for me to speak out my mind as well and give some insights. I think I might not be the expert, but I think I'll just try to do some justice to whatever knowledge I have. Just to start with, before I start on the shaping the future of investment banking, I'd just like to take forward some discussions on how finance is evolving and how times have changed in banking. So typically before the pre-COVID times, there were some traditional banks who used to strictly believe in offline working and all. And obviously, as we know now, we have moved to a hybrid model. So banks are no more insisting, banks and financial industries are no more insisting on working out of office. They feel that a hybrid model also works well. And this has been evident from the way the efficiency the employees have shown. I think we have felt that employees have been more efficient in a hybrid model as well. Of course, there are some jobs like front office wherein you require to be in office, but over a period now, the job market has evolved. We get prospective employees who typically ask that is there a hybrid model, and they really prefer in this type of environment as well. And I mean, this has been a great advantage to those people who have been working from their hometown as well. It gives them they can leverage their time in this aspect as well. Other than this, maybe one more point I'd like to dwell on is on the growing economy. Now, we have already been one of the pegged as the fifth largest economy now, and I think one of the biggest advantage India has is the population which we have. Being the emerging market, I think the economy is not going to slow down for us. I feel that we have a biggest advantage of growing number of investors coming out, foreign investors as well as institutional investors based out in India, who are really keen to invest. Doing and these are and of course there are private equity players who are bridging this gap. So I think that has been a biggest advantage. uh, there's a lot of awareness now, and I think the regulations, the regulatory bodies have keeping the financial industry, the banks at their toes to be transparent, to give a lot of information to the customers and keep them aware about what's how and keep transparency about what's happening. So I think that has been one of the crucial factor in terms of the way the banking has evolved. There are fewer chances, as you would have seen in the past, there have been less failures in Indian banks rather than those in foreign banks, and that's because of the tight regulations which RBI imposes and SEBI imposes. I think the financial industry, the banks, brokers, they have to be very transparent. They have to give a lot of information to the regulators, and it is quite evident from the way these inspections happen, the time on a timely manner. Uh, the banks, they have to give a lot of data, on a timely basis. And I think there is a very less ETA which is given. And I think that is very crucial in terms of the smooth running of banks and as well as the financial companies. So let me just throw some light on what are the major challenges in investment bank face. So typically, to start with, there is a scarcity of capital resource, and as I said just few moments back, although we have now got a lot of private equity players and institutional investors, there will always be a dearth of capital resources. I think due to coronavirus pandemic, there has been a recession and all over the world, and no doubt it has impacted India as well. So as a result, almost all markets, individuals and companies are not so comfortable investing. So there has been a shift from equity to debt in an individual investors as well. They have become they have become conservative. They don't want to take, so even an aggressive investor has become conservative, and that applies to an institutional investor as well. So while the pre-pandemic saw a lot of growth in startups, now the startup boom has kind of, there is quite a slowdown in the startup boom, and I think that is one of the main reason is because of the capital resource which is there. The job of an investment banker is to allocate capital resources efficiently. However, the fewer capital resources to be allocated there has reduced the business for the investment banking in general. So this is one of the major reason. Another one is the need to reduce the costs. So markets all over the world has become increasingly competitive. The prices of goods and services has gone up. Salaries of individuals, which we have been hiring have going increase. The salaries which we used to give to this a fresh MBAs or a chartered accountants a few years back has increased, and that's because of the increased competition as well. So I think that has been and that has hit the companies as well, because they have to for a person whom they would be hiring at a lower cost, now obviously the cost is increased, and I think that has really affect the workforce as well. So another point which I just dwelled upon was the increased regulations. The investment bank was blamed majorly for the mortgage crisis which happened in 2008, and this is the reason heavy regulations have since been put up into place. As I said, there has been the required need to give a lot of transparency. The scrutiny has increased by the regulators. This creates a limit in the operations of the investment bank as well. The number of new types of securities being created and traded by the investment banks have been reduced since then, and there has been separate departments to look after the compliances and changing regulations. Obviously, all this involves cost. Uh, One point which I think was on other technology disruption. I think there's a rapid advances in the technology, drastically change over the industry in the world. The world of investment bank is no exception. Over a period of years, an entirely new industry called the fintech has emerged. Cryptocurrency, bitcoins, all like India is getting to look into those type of areas as well. And there is a modern infotech companies that have shown more effective ways of raising capital as compared to the traditional investment banks. So, and this has led to a wider reach as compared to a traditional investment bank as well. So another most important part I want to tell was on the difficult in cross-selling. Investment banks have been traditionally relied on a lot of cross-selling. For instance, if a client comes looking for a merger and acquisition advisory on the investment bank, they're often able to convince the bankers are often able to convince them to avail services such as issue management, capital structure, advisory, and transaction banking. However, the investee he would like to look at the specialized services and might not go for the cross-sell product. So again, this has been a challenge to sustain other products as well. So these are few challenges I feel the investment bank is facing. Maybe I can just go up on the slide of shaping the future of investment bank. One of the top trends that most of the banks which have been facing is the sustainable financial products. Yesterday, like I was going around with the students, and they said that here in the campus also there is a solar panel which has been introduced. So I think like while the universities like these are also looking into this type of investments, there's an increased involvement and in terms of banks to invest in such type of environmental and social governance products. Finance and sustainability are predicted to go hand in hand. There is an increased awareness among the people to look at those industries and those banks who are investing in the cyber products. And I think that's quite evident in the way the investment has changed. So banks are in fact willing to sacrifice a short-term bottom line to stay with one step ahead of the competitors. Together with fintechs, I think banks are exploring the perfect opportunity to adapt to these new requirements and create sustainable finance products. 2023 will likely notice more social impact initiatives offering environment-related opportunities and finance-related guidelines with non-zero goals and such sustainable products. Adoption of artificial intelligence. Like we all know how AI is evolving now, and it is making a significant progress in the coming years, positioning itself in the most influential wave of technology. With every major industry leveraging AI and increasing intelligent machines to complement their work, or replace it by providing a superior level of competency. The banking and financial sector is slowly catching up with this trend. We have chatbots which are helping customers to solve their financial affairs, and banks are using algorithms to detect these the cyber crimes as well. The rapid evolving diverse AI technologies are impacting the banking industry. Organizations are increasing investments in AI to uncover their potential, assessing critical data, and improve business efficiency. The development and effective implementation of AI will likely guide the investment banking industry as well. Real-time payments will continue to be on the top. Like we see, like when it comes to payments, speed and accuracy is of utmost importance. With online these days, with the introduction of a new type of online payment applications, the real-time payment has become very easy. People are working on this type of economy to get paid at the end of their shift, and the need to send these funds for real-time payment networking, connecting them directly to the other banks. Real-time space less corporate and investment banks send their payments digitally to active customers. authorizing the payment, thus cutting down on the cost, and it takes when it comes to time. It is not just the companies that are benefiting from this. It also enables consumers to receive their bills directly into their bank apps or websites, thereby authorizing the bank to pay them instantly. Coming years will likely see a surge in the employment of real-time payment authorization, thus leading a smooth and secure banking. Digital currencies, I think we just touched upon those as well. 2022 has experienced a growth in the digital economy. Banks are learning to take them seriously. Central banks are launching digital currencies. I guess almost what recently I heard is around 10 countries who have launched digital currencies. And India is also making a foray into that as well. These are accompanied by the developing regulations around cryptocurrencies and the recognition that many of these core concepts of crypto trust will have enduring value. In the years to come, more financial institutions and government agencies will be sharing data and ideas on how to, on the ways to incorporate elements of these new type and into the global financial system. The need for talent. I think I just touched upon that. I don't know how the need for the correct talent is increasing. There is with the technology, it's becoming critical and for the banks to get the correct type of engineers, analysts, business analysts, and it is and this gives us this shows a stark reality. Banks aren't as effective as they used to be earlier because of there's an increase. There are other industries who have increased, and and they are also equally paying well what the banks used to pay. So I think that has created dirt in the niche technical workers or employees. The youngest talent particularly need flexibility. I just touched upon that, and they want to be valued in their job. There's a shift in the bank culture, which is moving from a traditional working style to a more hybrid working style as well. Forward-thinking banks are developing integrated plans to holistically address their employment issues. They are mapping the skills required to future and using a variety of approaches to recruit and retain young talent. So the rise of decentralized finance. So there's it is the decentralized finance which typically also looks upon the system such as blockchain and similar technology to provide secure, programmable, real-time transactions directly between digital assets holder. This indicates increased risk, but it also signifies more control and fewer processing fees. Many of the biggest banks are beginning to leverage bitcoins and other cryptocurrencies. Others in the investment banking space are speculating how a blockchain will disrupt the industry. However, the one thing is for sure that we are still in the early stage. So there's although maybe like students like your who are they would be aware about blockchains, cryptocurrencies. There's not so much awareness as it should have been. So I think it's going to still take time. The market is evolving, and it will take time by the time people start investing in cryptocurrencies as well. One way is the banks are staying ahead is to focus on developing proprietary market intelligence. The leading firms are setting up data warehouses, integrating data from multiple sources. Reliable market predictions, precious scoring systems, and other proprietary resources will be guiding force in winning the business. Omnichannel user experience. Today, I think the customer experience is everything. For like any the banks, typically we say the customer is the king, and this applies to all the industry as well. And this is again because of the growing awareness, the greater transparency which the regulators has provided. So brands are taking excessive measures to better understand their customers and to make a deeper bond. We have there are omni-channel experience which provides customers with increased flexibility and convenience. With technology continuously bridging the gap between physical and digital experience, the investment banking industry is engaging more digitally. Many consumers and small businesses are willing to do their own, which is why self-serve option is banking will continue to evolve, giving consumers the ability to confidently attain the goals by using the mobile app. And finally, just dwell on the long-term growth drivers. So global investment bank being a highly fixed cost business, require high level of trading market share, being the liquidity provider of choice to generate cash flows that can be reinvested to their business. The IB business is becoming more technologically heavy and needs to operate with a steady base of captive clients, such as corporates through transaction banking, which I already touched upon, institutional through research and custody, and retail in particular, wealth management, driving recurring equity revenue. The most important cross-selling business in this respect is the transaction banking for corporates to keep the clients business captive and allow ongoing product sales such as corporate bond issuance, foreign exchange rates, as well as hedging activities in these and other corporate classes. Transaction banking as a corporate capital business is allowing IBs to be able to predict more sustainable cash flow business. So I think this is some of the areas which I feel are going to be challenged and which are going to shape up the investment bank. Of course, most of these are evolving in India, but I think there's a lot of awareness and over a period now with the growing investment, I think we will see a lot of surge in this as well. Thanks.
Thank you, Mr. Nitesh, for enlightening us with the developments in the iBank space. He aptly touched upon the evolving change that we are going to embrace in future relating to sustainable finance products, which are accepted by today's businesses for raising funds. Basically, you see a recent trend in US which has come up with highest number of mutual funds investments pooled in ESG products. So the inclination of investors towards ESG, so they have become more ESG conscious, cautious, and they are moving towards that. AI, seamless payments, digital currencies, we are already in that spree, and moving ahead, we will have certain more amount of evolution going forward. Talent acquisition and management, where I hope every company in the world will face issues with the millennials demanding less work, more pay. Obviously, management across the HR streams of the businesses will encounter issues relating to talent acquisition and management. It touched upon another aspects of customer experiences, which is going to be integral in the businesses going ahead. With this, we will move to the next theme, that's private equity, the road ahead. But before that, we would like to introduce our next speaker, Mr. Vibhor. So I request Anusmita, please introduce.
Thank you, sir, for sharing your insights on the perspective of investment banking. I will now take the privilege of introducing our next speaker, Mr. Kumar Vibhor. Mr. Vibhor is a senior vice president at Tres Vista. He is also heading the family office, independent sponsor business, and managing client relationships. He has nearly 12 years of experience across asset management and consulting, having led teams working with clients across strategies, including some of the largest private equity firms, asset managers, corporates, and investment banks spread globally. Mr. Kumar completed his post-graduation from IIM Indore, is a gold medalist in chemical engineering from IIT BHU, Varanasi, and is a certified financial risk manager.
Thank you for that wonderful introduction. Good morning, everyone. It's really an honor and a privilege to be interacting with you guys here. XIM University has a great legacy. I've had the privilege of walking around campus, and it's a great, vibrant place. I see so many students who are going to be, you know, shapers of the change going forward. I'm really excited to have this opportunity to interact with you guys. And for that, I really want to thank uh, the organizing committee in Phoenix, CAS committee, Professor Mohanty, Professor Mishra, and all the faculty members, the media members for having me here and giving me this opportunity to share some thoughts. As Mitesh touched upon, I'm also no expert in the field, but hopefully over through my experience of the last decade or so, would be able to share some of what I've learned, and hopefully continue my learning alongside you guys as you go ahead. We've been very familiar with XIM as a campus. We've been visiting for the past few years. As we grow, I think one of the, I think Nitesh touched upon the fact that investment banks have had a lot of challenges with respect to sourcing talent, having other alternatives for students which have become much more and more attractive. I think we've witnessed a lot of that in our business. We've witnessed a lot of the trends which are shaping Finance 6.0 shape our business as well. We've launched businesses which are now exclusively doing analytics across financial services domains, right? So with that, XIM remains centrally in our plans going forward as well. Look forward to coming here again and again. When I was, told about, the overall business conclave theme and the broader topic in mind, I wasn't very sure of how familiar I think it's a diverse audience I have. So maybe I'd start with a very high level overview of what a private equity firm even is before we talk about some of the details around what's happening in the space and what is expected to happen going forward. Right. So as a few of you would be very familiar, private equity fund is essentially a fund which raises money from institutional investors, which are called limited partners or LPs. These are essentially pension funds, endowment funds, high net worth individuals, essentially what we call as institutional investors. They invest in the fund. This fund then invests funds on behalf of these investors to buy companies, right? So they will buy either stakes in companies or they'll buy out companies, which are essentially then become the portfolio companies. Hold that for a period of time, typically 5 to 7 years, depending on the strategy. Sometimes you hold out for longer. Now, GPs or the general partners are essentially folks who are running the fund, making all the investment decisions. They earn both a fixed fees as well as a percentage of the returns which they make to LPs. The financial returns are essentially generated by, you buy a company for a lower price, you're able to grow that company. Obviously, it's important to keep all of this in the context of the fact that these are private companies, right? So they are not subject to as much regulatory scrutiny, as much investor scrutiny, which allows for a lot of long-term value creation in these companies. And that's what our GPs are focused on. And essentially in the process, create returns which benefit both them as well as the limited partners. So that's broadly the business what a private equity firm does, right? There are different strategies within private equity. It's a broad umbrella term. Buyout is typically a larger stake acquisition. Typically, you acquire 50% or more of the target company. Essentially, acquire a controlling interest there. Some of the prominent names there are listed there on the slide. Venture capital, a field which probably you guys are more attuned to hearing, especially in the Indian context. It's essentially a sub-theme of private equity. Focuses on some of the earlier stage growth companies, and as these companies then become larger, more profitable, establish their business model, that's when the growth equity players come in, and then the buyout players come in. Growth equity is nothing but acquiring a minimum a minority stake in the company, holding it, growing it. Essentially, it provides the fuel which management companies need to drive the growth of the company. And then you also have alternative strategies. Right? When we talk about alternative strategies, investing in real estate, infrastructure assets, and a lot of these become increasingly prominent as finance world shapes. Right? We are talking about ESG, right? So how do you integrate best practices into climate management, right? How do you incorporate that into the way businesses are run, right? Or investments into alternative asset classes like cryptocurrencies. Every conference that I've been to this year, you hear nothing but digitization, blockchain, crypto, right? It is definitely a trend. Yes, Indian markets may not be ready for it yet, and there are questions around the long-term viability, the long-term risks around it, but it's definitely a mega trend, right? And PE firms are no stranger to that. PE firms have adopted that as an alternative strategy as well. Now, hopefully that gives you some context behind what a PE firm is, what does it do, the different strategies. Typically, from a private equity perspective, I would break down the entire chain of things which they do into four things, right? First, you raise funds, right? You approach investors. So there is the fundraising aspect, right? Then you think about where to deploy those funds. Where should I invest? Which company should I buy? What strategies should I use? How long should I hold it for? So that all the investing activities which a private equity firm does, right? When you are owning, when you have made that investments, you are trying to figure out how do I create value? Can I increase the company? Can I make it more attractive so that it just sells for a higher valuation, right? So that's essentially value creation. How do I integrate ESG into my companies? More and more investors are demanding for ESG-driven strategies. And then, obviously the exits when you realize those returns. So over the next few slides, let's look at what's happening in the industry from all of these angles. But before that, right, it's important to take stock of the current market situation. As Professor Mohanty, Professor Mishra, all of them touched upon the fact that the market conditions are challenging. Yes, there is growing talk of impending slowdown, maybe even a recession. Some would argue the US economy is already in a recession. It's been experiencing negative growth for the past couple of quarters, right? The classical definition of a recession. The global growth, which was going strong at 6% last year, is projected to go down to 3.2% in 2022 and further slow to 2.7% next year. Right? So growth has been slowing. But why has that been happening? It's a combination of a multitude of factors. First of all, I think the biggest reason which is slowing or impacting growth is monetary policies. Inflation is a term which you cannot escape wherever you go, where you talk in your households, you talk to your professors, you talk to clients in the financial services industry. It's a theme which has been weighing on everyone's mind. The inflation rate in US in September was 8.2%. To put that number in context, the 5-year average is 4.2%. So it's almost at double the levels. Right? It erodes a lot of value. And what's been causing this inflation? Inflation is not a near-term problem for us. It's been created over the last 12, 14 years. Like since the 2008 crisis, central banks around the world have been adopting expansionary monetary policies, right? Accommodative policies, which has ultimately come back and got us. Right? Now, what these banks are doing is essentially raising interest rates. So now you have interest rates which are at near 15-year highs in the US. There's obviously geopolitical elements. Russia's war with Ukraine has been weighing down markets. That has impacted financial markets. You have, the S&P 500 is down 26% or more this year. Indian markets are no different. When you look at volatility, I think there's a lot of volatility in the market. There's a index called VIX index. It's again much higher than its 5-year average. So that's the world that we are living in, right? How does that impact private equity? Now, it's important to keep in mind that private equity is operating in private markets, right? So it doesn't have as much investor scrutiny. Quarter to quarter returns don't matter as much, right? What you're looking for is long-term value creation, right? Having said that, is the market completely untouched? Absolutely not, right? There is slowing of deal pipelines. Fundraising has become much more difficult. And I think the area where the industry has been hit the most is the difficulty in exits. When you buy a company, you have certain targets. You bought it for, let's say 1 billion. You want to sell it for 2.5 billion, right? Over 5 years. You want to make 2.5x returns. Now, if the market conditions aren't favorable when you're looking to exit, what choices do you have? You have distribution commitments. You have LPs who have given you money only for 5 years, right? So private equity folks have been, placed with these conundrums as the public market valuations have really tanked over the last, I would say, the last 6 months. Right? Has valuation decline completely reflected in the private markets? Not yet, but private markets are catching up as well. Right? Now, on the flip side, lower valuations does mean that you can buy companies at a relatively attractive price, right? So that makes the future of it brighter, right? So you have just a few stats on the slide there. From a fundraising perspective or from deploying or making new investments, I think the PE market is fairly resilient. Exits is where the challenges are. Now, when you look at long-term outlook, when fundraising becomes a challenge, the long-term outlook can become circumspect, right? However, what mitigates this is the dry powder which private equity firms are holding. Dry powder essentially is the amount of capital which they already have raised, which has not yet been deployed, right? So looking at dry powder, there's still almost $1.2 trillion of dry powder out there, right? That's a huge number, right? So from a long-term perspective, it's mostly a blip in private equity, unless market forces really make the market conditions even more challenging. Now, quickly covering a few of the aspects of the value chain, which I touched upon. First, so I think the overall theme is fundraising has become much more challenging in the current macro situation, right? There are several reasons behind it. I think in general, the fundraising market has become much more crowded, right? On average, GPs used to come back for new funds every 4 years. Now, over the last few years, that has reduced down to 2 years, right? Which means GPs are in the market again and again asking for new funds, right? There was the fundraising in 2021 really set records, right? And it's difficult to match. So they're coming from that background, right? Another trend is, one, exits are difficult. Second, I think the average deal sizes have been increasing. So more and more capital is being raised. Companies are staying private for longer as well, right? So that distribution of capital to LPs has slowed down, right? Now LPs are also recirculating that capital, right? So you invest with a private equity firm, get some returns, invest back, right? So that return of capital isn't happening at the same pace, and there is increasing demand for capital. Obviously, that creates tension, so fundraising becomes more and more challenging. Another thing which has happened is for these reasons, and the other reason being the public side of your basket of investments has tanked quite a bit in terms of valuation. The private side, as I alluded to earlier, hasn't followed suit as much. The valuation has declined, but it hasn't declined by as much. What that means is, from a wealth basket perspective, LPs now have more private equity assets in their portfolio than they want. Right? If the target is to have 30% of my assets in private equity firms, I already have 40% assets, right? Which again, from a diversification perspective, makes them reluctant to invest more and more in private equity. Right? All that means is, fundraising has become more and more difficult. Now, in this difficult fundraising context, the second trend which has been happening is LPs are flocking towards more experienced fund managers. Think about yourself, right? It's a difficult financial market. Right? Which companies would you invest in? Would you go for your small caps, or would you go for your blue chips? The answer probably is blue chips, right? When there is more uncertainty, you will go for folks who have a proven track record. And not just the track record, there are existing relationships. If I have a limited kitty of money which I can deploy, I will give it to folks who I know, who I trust, right? Which is why LP capital is going to large funds much more than they are to emerging managers. What that means is if you are employed by an emerging manager client, they are probably going to have a tougher time. Right? Again, there are trends here which are different. For example, you will have emerging managers who are spinning out of your larger firms. So the Apollos, the KKRs of the world, you have MBs coming out of there and starting their own firms. They still have a proven track record. They have the metal, right? So they are finding it easier to raise money, right? Whereas folks who are relatively unknown, fundraising is becoming much more difficult, right? There has been a 70% drop in first time money raised by first time funds compared to 2021. Right? That's a huge drop. And the third thing which is happening is LPs want GPs to have more skin in the game. What that essentially means is, if you want me to invest in your firm, you have to have more interest in that firm as well, right? Now, when we looked at that PE structure, all of that capital primarily comes from LPs into the PE fund, but GPs invest alongside LPs as well, right? Now, typically that stake is fairly small, it's 1 to 2%. However, when you look at the past several years, that stake has been consistently increasing. Now, I think in 2021, that average GP commitment stood at 4.8%. Now, why is that? Right? Very naturally, you would want more alignment of interest. If you have your own capital at stake, it ensures that GPs are focusing on actual value creation in portfolio companies. Now, when the markets are rosy, it becomes fairly easy. You deploy capital in any decent company. The markets expand, the valuation multiples change from 7x to 10x, and you exit, right? So you have realized the returns, and maybe you have not done anything to deserve those returns. The company still has the same revenue, the same EBITDA, right? You have not really changed the business at all, right? Now, in a tough market situation, that becomes increasingly impossible, right? GPs have to have more focus on actually creating value, right? There's an increasing trend of companies looking for finance, for strategic sponsors, which are essentially companies who, when you're looking to sell, a company has two options, right? It can get that money from financial investors, right? And it can get that money from other larger strategic players who want to invest, right? To give you an example, Reliance invests in several smaller companies, not only from an acquisition perspective, but from an investment perspective as well, right? That's just one of the things. Now, your options when you are looking for a financial sponsor are also twofold. One will just invest the money, let it be, ask you for reports, and let you run the company as a management company. The second one will get actively involved in managing, right? When the going gets tough, management companies are looking for such strategic investors. We'll give them actual advice in running those companies, right? So there is, all of this happening, right? Increasing demand for LPs to put in more capital, right? And that also makes it, that's a double whammy, because if you're starting a new fund, are you really well placed to have that additional capital invested? Probably not, right? So again, that makes it much more difficult for new managers to raise funds. From an investment perspective, the second aspect of the value chain, now we have raised the money, so we are looking to deploy that money. There is a rise in growth equity investment. To relate back to the different strategies we looked at, there was venture capital, growth equity, buyouts, and then there are alternatives, right? Growth equity is somewhere in the middle of that value chain, right? Venture capital falls on the first side. Now, the middle part of the value chain is in treatment. You may ask, why so? Right? One, because firms are having to invest for longer, right? So even VC firms are now writing larger checks, right? They are encroaching upon the growth equity domain, so to speak, right? The buyout firms are coming back and encroaching because again, when the check size increases, it becomes easier for buyout firms to get involved. And why are check size increasing? Right? Because companies are staying private for longer because it takes longer to create that value. And public market conditions have been volatile. It was COVID a couple of years back. Now it is interest rates, geopolitical tensions. The markets have not really had. I mean, overall direction has been trending up at least for the last couple of years, but there has been a lot of volatility, right? So there is an increasing preference for investing in private companies, right? Which brings me to the second trend that there is an increase in trend of taking companies private, right? That's called a take private transaction. Right? When you take a public company, buy it out and make it private, right? In the first half of this year, $226 billion was spent. That's the highest since 2007. So that gives you a sense of the magnitude. And a lot of this is happening in the tech community, right? And you may ask why tech? Right? Now think about technology. Technology is one of those businesses where there's a J curve, so to speak, of returns, right? You do a lot of R&D, you do a lot of investments, and one of them then becomes the next Twitter or the next Facebook, right? Those disruptive forces take long to come in, and they require a lot of investments. Now, when you are under constant scrutiny of investors, hey, this quarter the returns aren't great, why don't you do something about it? It becomes difficult to create that kind of value, right? Which is why a lot of tech companies want to stay private. Their share in the private deals is more than 50%. The other aspect is obviously, the subdued valuations in the public markets, right? If you try and raise, if you go for an IPO, you don't get the kind of value which your company is worth as a private sponsor. So there are all these reasons why take private transactions are increasing. And the third thing from an investment perspective, which is happening is, there's an increasing number of consolidation which is happening in the market as well, right? Think about it, right? When you find it difficult to raise funds, when investments become difficult, you have to write larger checks. There's obviously going to be consolidation in the industry, right? A few examples out there. Eris recently acquired Landmark Partners. That was a huge deal as well. Over $1 billion in management. Like KKR acquired McKinsey's group as well, right? So overall, from a deal making standpoint, what I would say is, yes, there are challenges. Valuations aren't yet down. It's become difficult to sift the diamonds from the coal, so to speak. Every company looks the same. It becomes difficult to find the great opportunities. But and that's where I think when and we'll talk about disruptive technologies in a moment. That's where AI, that's where technologies come in and help private equity firms as well to identify such opportunities. Right. Having said that, there are pockets of growth. Obviously, take private transactions, growth equity are a couple of examples. Now we have invested our money. Now we need to manage it. Right. So let's talk about creation, portfolio management, so to speak. Right. On this, I think there are two broad trends that you can carry away with, right? And I've been talking about value creation for the past 15 minutes, right? Now that chart there gives you a sense of some of the levers by which a company can create value, right? There's obviously revenue growth. You grow your top line, your overall size increases. You had bought it for $1 billion. The company started generating twice the revenues. You can sell it for $2 billion at the same time. Similarly, from a profitability perspective, you either, one is you grow your overall top line, your profits increase. Second, you make a company more profitable. From 15% EBITDA, it starts making 20% EBITDA. You've taken, steps to enable that, and that increases your valuation. And the third one is the multiple expansion, right? You bought it for 7x, you sell it for 12x, right? The easiest way, right? Now, when you look at 2010 to 2015, the easiest way contributed roughly half of it, right? 48%. over the last 4-5 years till 2021, that had significantly gone up. Markets had been booming. You had all these, accommodative policies by central banks, easy availability of money. It's easy to deploy that capital, right? I can just sell it for a higher multiple because someone out there will buy. Right? In a tough market, that's what's gotten more difficult. Right? People are buying companies who have actually changed their business models. Right? There has been revenue expansion or margin expansion. Right? Which essentially means that GPs are now focused on that when it comes to portfolio management. And how do you create value? Right? There are several aspects, right? One is obviously you focus on talent acquisition, right? So your human capital of your business, right? The second is, and I think that's where the huge disruption which data analytics AI is bringing is on the portfolio company level. On the actual operations of companies, that's where data is giving management teams real-time insights into what's happening. How do I optimize my revenue? Which stores should I close? Which stores should I revamp? Right? Which markets are going faster? Right? And all of that is coming through more and more data. Right? So there is a huge focus of GPs in incorporating tech in their portfolio companies, and it's not as easy as it sounds. Each company is very unique, right? You as a GP, you might have invested in 20 different companies belonging to 3 different sectors, but each of those companies are unique to each other, right? Which KPIs will you track? Which dashboards will you look at, right? That's where a lot of the thought is being put. This also goes in the way due diligence is being done, right? When you are looking to invest in a company, you are looking, can I create value in this company? Will I be able to improve the margins? Will I be able to increase the top line? Right? Will I be able to bring in, changes in the company which will increase its value, right? And then a lot of this is being outsourced. Now, PE firms are elephants to say, to put it in a sense, right? They aren't the most agile, right? That's the way they currently function. Having said that, they are increasingly partnering with firms who are, able to provide them that level of insight. And it's very expensive to, drive these changes in any organization. Right? And the second trend, which goes back to the way due diligence is done, one of the strategies which has increasingly come into the market is the add-on acquisition strategy. Add-ons are essentially when you buy a company and it becomes a platform company of sorts, right? A platform company means you buy a company which owns 20 petrol pumps, then you go and acquire more petrol pumps. Each petrol pump is an add-on acquisition. Or you could acquire a company which owns 3 petrol pumps, right? And overall, you make it a company which owns 100 petrol pumps, right? This is an actual live client example who's doing the strategy in Japan, right? So, and then obviously, along with petrol, what other products could I sell? Where can I upsell my customer? I think they touched upon that. Right? Upselling has become more difficult for banks, but in general, everyone is focused on getting highest share of their clients' wallets, right? So even when you are diligencing, when you are looking to acquire your first company, which will become your platform company, you are thinking at it from that perspective. Can I make it an add-on strategy work, right? So yeah, I think from a portfolio management perspective, again carry forward with you. There is a lot of focus on value creation, which I feel is going to be better for the economy, okay? Because the financial services industry is now forced to make actual business change. Okay? You can't get away with just multiple expansion and someone willing to pay high. Right? You have to create that value, which then affects each of our lives as well. Now the last part of it, essentially exits, right? I think this is where the industry has really been impacted. There has been a 73% decline in IPO volume in the first half of this year. It's a huge decline. Right? Given the tougher markets, folks are not getting the kind of valuations and they are delaying this, right? Two reasons. One, obviously, there is public market volatility, there is tougher investment investor sentiment. And the second is when you think about interest rates, the debt markets, what's happening? Right? Banks are raising rates, right? Now that means that if you wanted, there are two primary sources of capital. You can either fund through equity or debt. From an equity perspective, the markets are challenging. You don't get the valuation you want. If you want to raise debt, debt is becoming more and more expensive by the day. Every time the Fed meets, the rate goes up by some crazy number. Right? So when you put both of these together, what choices do GPs have? Right? They have to return money to LPs. They can't raise more capital to do that return. So a couple of things are happening. One, continuation funds are coming. What are continuation funds? Essentially, you raise a new fund and you transfer the asset from the first fund to the fund. So it's a continuation fund, right? So you are raising money from newer LPs, paying off the older LPs. Some of them want to come to the new fund with you. They can do that, right? So this is on the rise, right? And there are, regulatory scrutiny of this as well, right? Because how do you judge valuation correctly when it's the same person who is buying and selling? Right? You can show value without there being value, right? So that's a regulatory dilemma which is there as well. I think the second big trend is the secondaries market. The primary market, everyone knows you go to a market, you raise money. Secondary is when you and me do any trading, right? I'm an investor, you're an investor. It just changes hands, right? So one private equity firm buys out from the second, right? That's the secondary market. If you look at secondary market volumes, that has really been rising and it's expected to continue to rise. Hopefully everyone's still with me. I know it's slightly long. But yeah, I think we touched upon ESG as a trend, and I think you can't talk about financial services or any industry at the moment without touching into ESG, right? The ESG market globally, in terms of assets, it's poised to cross 53 trillion by 2025, and that's going to be more than 1/3 of all the assets which are under financial services industry. That's the magnitude of ESG within the financial services industry. What's driving this? There are obviously multiple reasons. Like millennials are much more conscious about these things, so we are asking for that change, and companies have to comply. Right? Government bodies, governing bodies are putting a lot of focus. The UN has set 17 SDGs, right? And in order to implement those SDGs in developing markets, it needs $2.5 to $3 trillion of investment annually. That's a huge number, right? And can governments complete all of that through their own sources? No, it's a huge responsibility on the industry to be able to do that. And it's not just a responsibility; it's an opportunity as well, right? Because that's where the next value creation opportunity is there. It's the movement that's going to define the next couple of decades, right? In terms of returns as well. And there's been a shift in approaches, right? ESG is not new, right? And most firms looked at ESG from an exclusionary lens. Hey, I would not invest in a company which manufactures cigarettes, right? Or anything of that sort, right? Now that approach has changed, and ESG integration, which means that you are looking from an ESG lens while making that investment, or impact investment, where your business is investing money to create an impact, but not from a not for profit perspective. You're looking to create profits, but that profit comes from actual societal change, right? So these strategies are coming to the fore as well when you talk about ESG. Now, obviously, globally, different geographies have different trends. EU has been the trendsetter when it comes to ESG. The SFDR regulations were first implemented there. Now that has led regulators in the US and Asia Pacific to be catching up, but the markets are changing. There is a lot of focus on the US SEC now bringing more transparency guidelines to companies, which they have to disclose what ESG measures they have been taking. Right? And from a private equity industry perspective, that's also changing attitudes, right? Climate change and governance have been areas where the industry have been doing well, right? So when you talk from a governance perspective, am I doing business with folks who have the right business values? Is it like a sweatshop in Bangladesh which is manufacturing things? Those are the things which have already been there, right, for a long time. But I think the real lever where the change is happening is diversity, equity, and inclusion, right? That's the theme which has really been coming to the fore. I think when you think about it, I think Professor Mohanty touched upon a fact that how ready are we for this change, right? When you think about DE&I, right, having gender targets, having ethnicity targets, right, and if you think about a country like India, right, how many ethnicities do we have, right? How do we bring folks from everyone into the community? These are challenges which are being faced by our educational institutions, our governments, and our industry, right? Personally, I am on the I head the DI committee at Resist. I can vouch for that. And when we think about our DI strategy, it's a very complex animal, right? We have to. It's not only about you woke up today and you implement a policy. How do you change your existing culture so that this actually implements change, right? But change is happening, right? Perception driven ESG strategies are a thing of the past, or are increasingly become a thing of the past. Now ESG has become one of those means of value creation which have been hopping around for the last hours. Now, a lot of this I've spoken from a global perspective. I thought it would be apt to touch upon the Indian, what's happening in the Indian markets. Yes, the near-term challenges are there, but I think when you look at the long-term picture, the Indian markets have been doing really well. Right? India is the fastest growing economy in the world, and its share of the global economy has been going up. I think we currently contribute around 22% to the economy. Yes, we have challenges of inflation. Yes, our markets are down for the year as well. But from a private market perspective, I think the outlook still remains fairly strong. Again, similar to the global markets, exits is where the challenges have been. Fundraising has been strong. There is focus on ESG. There is investment deal state has been good. The average check size has been increasing as well. You have several prominent players, global players who have become much more active in India. Your Blackstones, your KKRs, your Carlyles, your SoftBanks. You will hear all of these names in news, right? They have become a lot more interested in India. And what are some of these long-term drivers of the private equity industry in India, right? A big part of it is to do with what's happening in China, right? The geopolitical reasons, the slowing of the Chinese economy, the crackdown on tech companies. You remember we spoke about 50% tech companies trying to go private. So tech forms a huge aspect of the private markets, right? And this year the Chinese government has taken some policy stances which haven't really rubbed off very well with the tech industry. Right? And employment in China, 31 major cities of China is at like 20% this year. Right? These are huge numbers, right? And all of that doesn't mean that the Chinese economy has stopped growing, but there is a lot more growth which has been happening in India, and that's expected to continue to be so, right? I'm sure you, as finance students, would be reading newspapers, right? And unicorns is a term which you would have heard, way too often. And the reason why you have heard it way too often is because it's happening way too often now in India, right? Last year we created 44 unicorns, almost 4 unicorns a month. This year I think the pace is slightly slower, but I think we're still at like 3 unicorns a month, right? We'll have 250 unicorns by this pace by 2025, right? So we are creating those next Twitters and Facebooks of the world. This is where the action is, right? Mitesh talked about we being the 5th largest economy. In 5 years, we'll be the 4th largest economy, and hopefully, sooner rather than later, right? With all of you joining the workforce as well. And a lot of that is to do with increasing digital penetration. We have the human capital, we have a really young population, and a lot of that is now coming onto the internet using platforms, right? There is a lot of scope for digital strategies having more and more disruption in the Indian economy, and that means that overall, if you're working in the Indian financial services industry, especially on the private market side, the outlook is positive. Nothing to worry. All right. I think, yeah, I've gone on for a while, but before I bring this to a close, it's only apt that I touch upon some of the longer term disruptors, and I think that goes hand in hand with the theme you have in here, right? What's changing, right? We've heard these terminologies, right? Robotic process innovation, right? And artificial intelligence and blockchain, right? And so on and so forth. How is that impacting the private equity industry per se, right? It's not new to the industry, right? These things have been around for a while, and even today, PE firms have been using it, right? Now, where they have been using it is in areas like deal origination, which means to identify these opportunities. Right? I was talking to you about, how do you sift through companies which look the same, but identify which ones are where the value is. You have to crunch through the data of that company. Now, can you do that manually? It's not reasonably possible within a window of time, right? That's where AI comes in, right? When you talk about value creation, that's where AI comes in, because each of the 20 different portfolio companies has data in different formats. Now, some kind of standardization, some kind of uniformity across all of that's where data analytics tools are bringing the change, right? Giving investors and management real-time insights into what's happening with their business and allowing them to pull those levers which will create value for the longer term. And when you look at the future, how will AI influence the industry going forward? Exits, right? How do I automate the exit process? When does AI tell me that, hey, 6 months down the line, the valuation, this is the trend and the valuation might be right. Let's go ahead and start finding investors who can potentially buy my business. Right? That's where AI will come in. Right? How does due diligence, right? Even before acquiring a company, I talked to you guys about whether an add-on strategy is possible or not. That's an increasing trend, right? How do you do that study in an automated manner? And that's where AI is coming in, right? Leading to higher accuracy, quicker results, and you are able to focus on productive tasks. You are able to focus on value creation that brings on societal change. Okay? And can a private equity firm do all of this by itself? The answer is probably no, right? So they're relying a lot more on outsourcing, not only the core functions, the back-end kind of roles, but these are the value creation roles which they are looking to source from the industry. It becomes very difficult for every company to have that kind of expertise in-house, right? So there's an increased focus on outsourcing, and from a crypto perspective or a blockchain perspective, there are two things which are happening. One, as an alternative investment strategy, cryptos are becoming integrated into private strategies. But the other aspect, which is probably has a lot of potential and really, really new, is the tokenization of funds. Right? Tokenization is essentially, when you create smaller pieces of that private equity, like billions of dollars of funds, so that more retail investors, not like you and me, but still of a certain sophistication, can invest, right? And once there is enough, and KKR just last month tokenized a $4 billion fund. Right? KKR is one of the largest private equity firms in the world, right? So the leading players are leading that change, right? Once that becomes reality, there could be a secondary market for private tokens, right? You and me can hold tokens, and we might be trading them with each other, right? So the scope of it is really exciting to see, and yet to be discovered. No one can tell you what will happen in this field probably in 10 years, but hopefully that gives you some insights into what's happening in the private equity world and what is expected to happen, right? With that, I would like to bring this to a close. I see so many exciting young talent out there, and you guys are the ones who will drive a lot of this change. If you're learning about Finance 6.0, you'll be the ones who will be executing Finance 6.0, right? Your professors talked about change being the only constant, and you being the drivers of change, right? I just leave you with a quote from Barack Obama. Change will not come if we want it or if we wait for some other person or some other time. We are the ones we've been waiting for. We are the change that we see. Thank you so much.
Thank you for enlightening our students and answering several intriguing questions that we have in mind regarding the change in the space of private equity. I would like to highlight on some of the interesting things he touched upon, like the flow of the private equity firm, starting from the raising of funds to investing to portfolio management and the exits. Most interesting was the add-ons in the portfolio management part, which is going to have a major role and the process approach that portfolio management by the PE firms are conducting these days. Exits and in exits the continuous funds, which is again replicating effect on the PE industry. The ESG drivers were one of your highlights, and we have a lot many to think and ponder upon going forward. Uh, uh, I remember one of very old research, probably whether financial development is included or is important for economic development or not. That was the question posted to us when we started running the 19th century, probably when all evolutions in the economy started to come up. Theoretically, we studied in classes, we studied in the economics class, in a major economics class, we studied the two classes of theory guiding or hypothesis guiding this development, one being the supply leading and the other being the demand following hypothesis. Demand following is where more of economic development taking place and followed by financial development. As economies develop, it demands for more and more financial resources, and hence a requirement of financial development takes place in the economy. The other one being the demand following. You give someone with resource, he will do something with it, and which will contribute indirectly to the economic development. Basically, these days we see the supply leading taking much of the part. All are funded with research, or all are funded with resources, basically financial resources, and they are being employed with such optimality that economic development is achieved. And one of these objective of our finance 6.0 is how we keep up that development with increasing financial development and the development in the space of finance. Before we go to the question and answers sessions, I would ask Professor Mahanti if you have something to add on the discussions. Yeah. Okay, the house is open for questions. You have to ask whom the question is targeted among our two panelists.
Thank you, sir, for the pertinent discussion on the way ahead of private equity. This marks the opening of the question and answer session. Students are requested to present their questions to both the speakers with a raise of hand.
Good morning, everyone. I'm Prachi Dhar from Bachelor of Commerce Finance. So my question is to each of them. So first I'll ask to Vibhor, sir. So although you mentioned it before, but I want to know in a more depth way. So before, huge liquidity and easy money was chasing private equity, but now the huge rate hike by the central bankers, the funding is drying up. So what's your take on that?
audible?
Yes.
Thanks, Prachi. Great question. Yeah, I think from a longer term perspective, rate hikes are here to stay, right? Inflation is not a problem which will go away, and you can see that playing out in the Indian markets. Like it seemed that the RBI interest hikes were curbing inflation, it was coming down, and then the September numbers came out, and it surprised all of us, right? So these things take time, right? And where the private equity industry is different than investment banking or public markets is the time horizon, right? So from that perspective, the private equity industry is impacted, but there are strategies which they can take, right? Add-ons, value creation, continuation funds, secondary markets, right? All of these are things which they are resorting to overcome that, right? Yes, there are challenges, but then there are pockets of growth, right? Buyout funds are now investing more in growth funds, right? People are making investments in uh, for longer durations. There are industries which are facing challenges, right? So your conventional industries, which are your retail, your travel, all the consumer related industries, may not be the best for investment at the moment for private equity firms, right? They are flocking towards technology, healthcare, and financial services, right? That's where the action is, right? So, yeah, I mean, long story short, there are definitely challenges which the PE firms are facing, but I think a lot of this is shorter term. Even exits, which I harped upon during my speech. I think if you look at past track records, typically they have lasted for 2 or 3 quarters, and the market has always bounced back from a private market perspective as well, right? So long term outlook is positive. The short term outlook is cautious.
Sir, I have a second question for you. So in my opinion, I believe that Indian regulations aren't that friendly. So we see a lot of shift in Singapore or Mauritius or New York. The trend is going there. So what's your take on that?
Yeah, no, definitely. I think the broader picture of the Indian market still uh, isn't the most business friendly when you talk about global markets. And whenever we are visiting our clients, speaking to folks at conferences, they, a lot of them have, notions about what it is like doing business in India, right? But I think when you talk about the delta, right, the change in people's perspectives, right, that's very palpable, right? When you speak to people, any large private equity firm will not, it will be very difficult to find a private equity firm which doesn't have India in its strategies, longer term strategies, right? And that's the change which is happening. I think I talked about the China versus India comparison, right? And we are experiencing twice the amount of growth than China in the private market, right? So yeah, from a size perspective, we are still nowhere comparable, but I think the future belongs to us, right? And to be honest, I'm not sure if you guys have intentions of going abroad, working in financial services industry in the US or Europe. India is where a lot of the action is for the next few decades, right? We are people wanted to go to London once upon a time. We are a bigger economy. Our cities are in much more better state than London. I can tell you the experience, right? So, yeah, hopefully that addresses your question.
Thank you so much, sir. So my question is to Mitesh sir now. So nowadays I see merger and acquisition is very rampant. So the role of investment banking is very huge. So can you highlight more on that?
Sure. Thanks for the question. So I think the way the investment banking has evolving, there's an increased pressure, and on the way the investment avenues are, the banks are looking at investment banks. So obviously there is the gap need to be bridged in terms of the way how the investors are looking at in terms of investing in these type of companies, and how the end investment banker is bridging the gap. And obviously, post-pandemic, things have evolved. There is an increase since there is and to your earlier point, although there is a dearth in liquidity because of the increased interest rates, but the investment bankers are increasingly finding avenues in the way engaging in better type of companies, looking at how to get the right type of investments done. And I think definitely the tier one investment banks and tier two investment banks as well are finding ways to bridge this gap and find out more lucrative way in investing as in these type of M&As or IPOs which are there. So hopefully yes, things are going to change, and I think even though the market has been volatile, I think definitely once the investors get the right type of investment companies, the investment bankers are going to bridge this gap and find better avenues in terms of investing.
Thank you, sir.
Good morning, Mitesh sir and viewers sir. So my question is to viewers sir. My name is Gauri Shankar Das. I am from MBA first year batch. My question is related to bit of market, secondary market. So the question is, with every adversity in the market, we see there is opportunity. Like in Corona time, there was the boom in the pharma sector, energy sector. So we have seen some value there. During this wartime, recession time, so where do you see the value in the businesses? Which businesses are likely to grow? That's my first question. Second question, I will go.
Thanks. Yeah, I think when you look for value, and when I speak to clients, a lot of focus is there on technology, right? Like the three sectors which I spoke about, right? One is financial services, a lot of, and I think Nitesh touched upon fintech, right? That's become a sector of its own in the last decade or so, right? So there's a lot of focus on that. Healthcare and the integration of technology into healthcare, right? Not only in developed countries where technology was always, the healthcare sector was a lot more formalized there, unlike the Indian markets or the developing country markets, where we are catching up, and a lot of technology-driven innovation is coming through. And the third is essentially the tech-enabled services, right? From simple things like investing in technologies which are changing normal businesses, right? We have like very recently I met a client in LA, and they were ranting were going on about investing in a business which presents all your plumbers or your electricians in your house complex or allows gatekeeper entry, and they found it like really amusing. I could just open my phone and showing that we've been using this in India for the last 5 years, right? So in a lot of these senses, there are a lot of technology-driven innovations which have been there in developing markets, which have not really penetrated into other markets, and the other way as well, right? So those are the pockets of opportunity which will stay on even in the turbulent times. And from a value creation perspective, if you are holding on to a company for another 2 years, you need to do something. You can't just hold on and hope for the best that there will be an increase in valuation, right? So you then, as the management of those companies, integrate technologies, integrate efficiencies, whether it is supply chain, whether it is your hiring funnels, right? Improving the efficiency of your hiring process, right? How many folks do you interview for closing that one position? How do you compensate for talent? How do you, motivate talent? There's, the great resignation, you would have heard this term, right? It's a huge challenge which not only percolates in the financial services industry, but in the industry in general, right? So technology is being increasingly looked at as a potential solution to some of these challenges. Now, whether or not it is the answer to all the challenges remains to be seen, but yeah, that's where the industry is headed towards.
Thank you, sir. I'll go to my next question. As you know, the banks are the backbone of the economy, and if it is affected, all the stocks and everything are affected. So in this time, the rate hikes are there, and like inflation is there, and we might see some increase also. So how do you think the banks will be affected in this, in 1 year or 2 year view? So will there be any much impact in the revenues?
Probably Videsh would be better placed to answer that, but I can take a crack at it. So I mean, purely from our client base, right? I think banks are a more volatile, but a very resilient entity itself. Banking has been around for as long as the financial services industry has been around, right? So yes, banking has been facing challenges, right? And then there are pockets of it, right? When you look at consumer banking, um, and I think you have a few speakers who talk to you about consumer banking, right? Integration of chatbots, like automatic account openings and all of that, right? The bank that's optimizing the operations of a lot of consumer banks, right? From a deal making standpoint where the investment banks come in, that will always go through volatility because that's market driven, right? When we had COVID hit, a lot of our investment banking clients struggled, right? But that was a 6 month struggle, and they then came back rolling once the markets came back, right? So depends on which aspect of banking you look at. Banking is an umbrella term which applies to a lot of different verticals. But what I can tell you is, from your perspective, if you are figuring out, hey, I want to go into banking, and which sector to go into, depends on your risk appetite as well. Banking is a risky sector because it is cyclical, but definitely, the long-term prospect remains positive. I'm not sure if you wanted to ask something.
So yeah, just to add into what Vibhu said, obviously there are challenges which bank have been facing, but it's the way how they have evolved. Like the traditional banks have also invested a lot in technology, and the more they invest in technology, how technology friendly the apps are, the sites are. I think that it will be more customer driven. So obviously there has always been a focus to be customer driven, whether at the retail side and the wholesale side as well, and the more transparency it is there. I think those banks are going to sustain, and they'll come out of this challenge in time as well. So yes, it has been challenging time, but I think one of the major and biggest advantage which I mentioned upon is the Indian population. I think we have there's an increase in the customer base as well, and there we see that there are a lot of banks have although they have been facing challenges to sustain the customers, but they have been getting new customers as well. And that's where, if you want to sustain a new customer, you have to give them what they are looking at, technologically, the services in each way. I think, and that's when bankings, whether it's a foreign bank or whether it's an Indian bank as well, they are going to survive.
Thank you, sir.
Good morning, sir. First and foremost, thank you for such an insightful session. My name is Vedant Das. I'm a first-year postgraduate candidate pursuing Masters of Business Finance. My question is to Mitesh, sir. My question is, how the artificial intelligence and predictive analytics are shaping the mergers and acquisition area?
Hi, that's a good question. I think the way the data has been looked, in terms of in investment bank as well, and artificial intelligence definitely, with the way we look at it, how it saves time now in terms of the financial modeling, in terms of predictive analysis, how we both mentioned about how for the deal origination also, how if an analyst will look at 20 companies which are quite similar, how AI will definitely help on performing the analytics. It will save time, and it will kind of even give results as well. Obviously, the final touch upon will be done by a business analyst, but AI and fintech will definitely help in giving doing the much of the data crunching in a much faster way, so which can help in saving time, giving faster results, and responding faster to the customers, because these days investors look on for a fast turnaround time, and that's when I think AI will definitely help in doing that as well.
Thank you, sir.
Good morning, sir. My name is Tanya. I'm an MBF second year student. I would like to pose a question to Nitish, sir. Actually, I'm very interested in right now after the advancement of technology, data is so readily available. And with the access to data increasing, there is asymmetry to data also increasing in this market. What does an analyst do, or what kind of steps do they ensure to make sure that their information is of maximum validity so that their forecast and prediction are of maximum effect?
Good morning, Dania. So I think one of the most important key part to do an analysis is that getting the right type of information from right sources. So I think you all should have privy to the right sources, which gives the correct information. And I think that's where then you can take ahead the analysis and do much of the data crunching which would be required. So there are websites, and a lot of information which has been given by the regulators as well, which can give you the right type of information. Obviously, when you get information from any other unaccredited sites, you can maybe recheck it with the regulators. Because a lot of these are published by the regulators, by MCA as well. You just have to pay some nominal fee, and you get financial information from the MCA sites as well. So, and the fee is quite nominal to get and recheck this, So I think something like this can be done to do the data validation and then move ahead with your analysis.
Thank you, sir.
Although it's not a question, but in order to enrich the discussion in the recent context, I get bombarded in the classes with the recent debacle of credit Suisse, although not to comment personally because you might be the competitors. But it's a general question. How do we handle ethics in this space actually? Because all these four cases which have ran this bank into a trouble are somehow or other based on some of the ethics that they have divergent from their normal course of. So your takes and thoughts on how ethics must get integrated into the domain of finance, so that going ahead we don't encounter such issues. If I can have from both of you.
I think this is a very good question. So ethics is deeply driven by an individual's own conscience and the firm value as well. So every firm has their core integrated value, and they keep ethics in the topmost value because that's how the firm is known. And there's a core competency driven thing. Obviously, I've been fortunate enough to work with managers and mentors, who are deeply driven by the ethics, and that really brings a lot of responsibility and accountability in the way you behave, the way you look at things in your workspace, the way you approach at any of the issues, and I think from time and onwards, this thing has generally been mentioned in the town halls and the various committees that how important our ethics are in the workplace. And as I said, again, second part is how individually a person is in terms of driving it in and imbibing it in himself, and then bringing it in the day-to-day work or in the work culture. So it goes both hand in hand with the institute as well as individually.
A great question, but I think as Vitesh rightly said, it's a mix of values you hold as an individual, and it starts right from here, right from where you are getting these values at your educational institutes or where we've come from, right? Having said that, each of us will have our own individual values. Each of our values will evolve over a period of time as well, right? So establishing guidelines and borders to that through organizational values becomes important as well, right? Which is where the third pillar of ESG comes in, right? Governance, right? There is a huge focus on governance practices. Compliance as a function has been growing. I think later today one of the speakers will touch upon that in the Indian context, right? But compliance has become extremely important, right, in the financial services industry, right? People want to partner with anyone who has robust compliance practices to avoid exactly the kind of issues which happened there, right? So discouraging the essentially making the risk reward proposition really lopsided, right? You may gain from it for the short term, but the longer term impact of it is of huge consequences. Organizations realize that the problem is percolating into each and every individual, right? Which is where the governance practices are developing. There is a lot of focus on, as Nitesh touched upon, right, town halls, right? Leadership communicating those values and practicing that themselves, right? So hopefully the days of the Wall Street bankers not having the greatest ethics are going to be a thing of the past, and we'll have some model financial services citizens, or more of them whose stories will be brought to the fore. But yeah, governance is a big area which will continue to develop over the coming years.
So I'd like to add one more thing is there is so there are a lot of trainings also which happen in most of these high-end institutions. How these ethical standards are to be maintained, and there is an absolute zero tolerance for if these are not maintained. We generally an employer would not be even asked to before his sacked if these ethical standards are not maintained. So, and the most important is that these standards are directly or indirectly affects your bank's operations as well. So obviously, if these are imbibed in the culture, I think it definitely works in favor of the employees as well as long-term growth of bank.
I think we are in Finance 6.0 already. So giving thoughts on how we should integrate ethics into finance going ahead, although it was how we can avoid such debacles coming ahead in the coming days. Yeah. Please, sir.
Hello, good afternoon, sirs. I am also Kumar Mishra, one of the member faculties of School of Commerce. Hopefully, my question is the last question before we break for the lunch. My question to Mr. Vibhor, as you mentioned one thing like most of the deals are now when the exiting happens, like companies are not so interested in getting an exit route through IPO mode. Secondary market transactions are more. Is it a choice by them that like suppose a company is going to the market through IPOs, general investors will also get benefit out of the wealth creation. But what is happening right now? The wealth is now again within the hand of very few people. That is not trickling down to the market, like people like me and some other like people. So why is it so? Like, is the regulator thinking of like putting some imposition that like not imposition, persuading companies, PE companies or the other companies, those who are investing in these, that they will have an exit route through an IPO?
Thank you, Ashok sir, for that question. A great question, I must say. I think from a preference perspective, I don't see as much of a trend. There are obviously pockets, right? I spoke about technology, right? Technology by and probably healthcare. These are industries where a lot of investment is required. You invest a lot in R&D for that one disruptive product or that change, right? Where staying a public company exposes you to scrutiny of retail investors, right? Which is where there is in such pockets of the industry, there is a preference to avoid IPOs where possible, right? Having said that, a lot of companies do love the IPO route. It is definitely, that ability to have retail investors come in and participate. I think it's an easier exit route as well because management companies often when the private market transactions happen, there are a few individuals involved, right? From a management company perspective, if I'm the CEO or the COO a lot of the time our own jobs might be at risk, right? Because what if the investor wants, as part of their value creation mechanism, want a new board of director member come in, want a new CEO infused to drive change in that business, right? So from all of those reasons, right, IPO is still the preferred way for a lot of folks, right? Having said that, the valuations which companies are getting in the market isn't justifying that enough, which is why more and more are resorting to secondary markets, continuation funds, the other means of valuation, right? So definitely from an exit route perspective, IPOs are here to stay. But yeah, there is a growing trend in the private market where folks are keeping companies private. Now, I think you also touched upon what are regulators doing, right? I mean, well, it will stay in the hands of a few folks. There is, I touched upon continuation funds, right? You are selling from one fund of your own to another fund, right? How do you decide what the right valuation is, right? Valuation will be whatever you say the valuation is, right? So how do you regulate that, right? So there is a lot of activity happening in the US for by regulators placing more disclosure norms on private equity firms as well, right? PE firms are coming more and more under the umbrella where they have to disclose operations, right? And that extends to, ancillary investor classes like family offices, which have traditionally been your black box, right? Your large family offices with billions and billions of dollars make investments across all asset classes. They don't have to disclose anything, right? So there is a lot of lobbying happening to bring such sectors of the industry under regulation. Now, what will be the shape of that is yet to be seen, because obviously, there are benefits to having private markets as well, right? So it's a balancing act which regulators are trying to do as well. But yeah, hopefully, what comes out of it is a more regulated, stronger private market with obviously IPOs continuing to be an important means of exit going forward as well.
Hello, sir. Vedant here again. My question is for Vibhor, sir. So, how ML in private equity is shaping the whole area? Because ML, as far as concerned, is selecting the data, training, analysis, and the results, and it's an iterative process. So, how this thing is shaping the private equity area?
Right. Yeah. And, great question, Vedant. So machine learning, like anything else, any other aspect of analytics, is definitely driving a lot of change, right? You see that in hedge funds when they are, back testing their strategies to come up with new strategies, right? So that's a huge area where that is getting applied. Now, machine learning is being applied at a company level to see how past performance has been. What are the factors which have driven that, and how can you learn from that and incorporate practices which will benefit in the future, right? So a lot of focus from a private equity perspective has gone into incorporating that into the assets that they own, right? Which is where again a lot of non-standard data exists, right? So machine learning isn't that easy to implement. And then obviously there is the cutting edge industries, right? Your cryptos, your blockchain. All of these are new areas which have come in where there is a lot of AI implementation. There's robotic process implementation which is going into areas. A lot of PE firms, when I refer to them as elephants of the sort, a lot of them are very dependent on Excel, right? Excel is a great tool, but it's an old tool, right? Increasingly, you will see investment professionals at PE firms are now trained on dashboarding tools, right? And I think you guys get some exposure to that as well, right? And that's because the industry has been demanding, right? So definitely these are levers which are shaping the industry. Machine learning being one of them.
Thank you so much, sir.
I now take this opportunity to thank our esteemed speakers for such an enriching session and Professor Dr. Shivangi Mishra for moderating the session. I would now invite Professor Dr. P.K. Mohanty to propose a vote of thanks, followed by a felicitation to our esteemed speakers by presenting a small token of appreciation.
Two interesting topics and two experts in their relevant fields. And the question and answers session also added value to this discussion. The discussion was not only interesting, but also very inspiring and thought-provoking. I'll start with Mr. Mitesh, who very nicely spoke about the future of investment banking. He started very well with the hybrid model of working, the challenges of investment banks. But what got my attention is there's a need to reduce cost. When I teach accounting, I always tell my students that if there is no possibility, it's not possible to raise your top line and raise your middle line, reduce your cost. That will add to the bottom line. So yes, we agree with you, sir, that there is a need to cost because corporates over the years, why over the years from time immemorial, we always try to make a contained cost. And if it goes beyond the point, the issues get prominence. And due to increased regulations also, how the investment banking is getting affected, you very nicely explained. And technology disruptions that are taking place, I think that goes a long way in reducing cost. You also talked about sustainable finance products. And you also talked about the need for talent. I will come to that a bit later, because this is quite common in the two topics, the discussion about the two topics. When I come to Mr. Vibhor, he also very nicely explained, started with ABC, like what is private equity, which is quite interesting. We might have thought of private equity in some way, but the way he explained was really interesting. And he talked about the value, long-term value creation. In M&A, we always talk about value and how value is created, or how value is unlocked. Your discussion is centered around how value is created and how the private equity is playing an important role in that. You also talked about the high inflation, uncertainty. Yes, inflationary situations are there. It's prevailing. And as you know, in our country, tolerance limit is around 4%. But that it is nowhere to be seen now because of the high inflation rate currently going on. The valuation is also getting affected. Geopolitical issues will be there. It has been there always, and now it has been magnified because of the Ukraine war and other things. Taiwan is coming in a big way. Taiwan issue may also become another geopolitical issue. So those things will remain. Challenges will remain. But the finance professionals have to find ways how to manage the things. One interesting thing you talked, Mr. Vibhor, is the consolidation taking place. And I would also refer to one question raised by a student, Ms. Prachi, that M&A is taking place more and more nowadays. And I will also agree with her that because of lower valuation due to COVID, many companies have become target for M&A. So consolidation is taking place and will take place. This M&A is going to stay. It's not a temporary phenomenon. And you also talked about the related valuation, value creation, technology, and also all the talent acquisition. which I find common in both the speakers' deliberation. It's the talent that company looks for. That is why we all talked about the skill shortage. Whether I possess certain skills today, whether that is important today or not, the market will decide. Because whatever we know, we have to replenish it. That will not sustain us for a very long time. That is why we have to add on, we have to add to our skill sets. You also talked about the ESG as a driver for growth. We also talked about the Twitter and Facebook, that private equities are creating more Twitters, more Facebook. And I will also link to Professor Sivanjan's question on ethics. I remember a long back someone saying ethics is a very boring subject. We offer ethics in new programs, but sometimes we say, in music programs also, sometimes we say ethics is a very boring subject. But if you agree, I'm sure you will all will agree with me that ethics is there in every course. In accounting also, we can have ethical discussions. But since you said, Mr. Vibhor, you referred to Twitter, is Twitter ethical? Is Elon Musk ethical by shelving the proposal? Because, and you talked about the disclosure practices. If you disclose more, that adds to your ethics. No doubt about that. But now of course, he is again proposing to buy Twitter. So this technology disruption is common in both the speakers' discussion. And we cannot imagine the finance world without technology. Rather, I can put it this way, let us reimagine the world with technology. Otherwise, it will be difficult. Without technology, technology has made our lives simple. There will be more and more technology. Technology will also change. Whatever technology we had in the past, those technologies may be outdated. So technologies will remain. But what is important is who drives this? Besides all, behind all this, when we say drivers of growth, besides all this, behind all this, there are the human beings, the skilled manpower. So it is now the turn of the talented people, talented finance professionals to live up to the expectations, to live up to the challenge. I also would like to thank Professor Sivanjan Mishra for nicely moderating this session. And I also would like to thank all the students for their active participation, for their engaging participation. I would like to thank the interesting questions that you have raised. And my vote of thanks will not be complete if I do not take the names of the organizers of this Infinix team who have worked for months. And though I must also thank the people from the career advisor services who have given their best, the people who have made all this arrangement without which it would not have been possible to have a very cozy environment and the discussion would not have been interesting without their support. So thank you very much. Thank you for your active participation in this annual discussion of P1. Thank you very much.
With this, we'll break for lunch. I request the students to be seated after a few minutes. meetings all the time.
Very good afternoon to one and all, and welcome back to this post-lunch session. I'm sure you had a great time in the first session, but I can assure you this is going to be more exciting and more thought-provoking than the first one. Let's see. So, a hearty welcome to the dignitaries on the dais and our Dean Sir, Professor P.K. Mohanty, and also our speaker for the first session, and dear students. Hearty welcome once again. Finance 6.0 Changing Outlook. When we started this, one of our favorite students, Akshay started with Benjamin Franklin's quote. Is he there? Oh yeah. He said the best investment we can make is investment in knowledge. I would like to take a cue from that, and I would like to say that the best investment we can make is an investment in knowledge in finance. Let's tweak it a little bit. I was reading this book by Morgan Housel, Psychology of Money, and it said that there are two valuable things in life, only two, he said. One is health, we just discussed when we were having lunch, and the other is money. So we are in the right place, discussing the right thing, and with the great stalwarts of the industry. The world is flat. Thomas Friedman. We believe it's round, but it's flat because of globalization, because of changing economic environment, and because of the leveling that has been happening, particularly because of artificial intelligence. And so we have picked two great topics for this discussion, AI and also governance. Now, they are fabulous in their own way. When you talk about artificial intelligence, that's the thing that is shaking the corporate world and everywhere else. I was watching this small video this morning, and they said there was this guy from US, and he said that life is so easy out here. He said, Alexa, make the coffee for me. Alexa, do this for me. Open the door, and the door opens. And then this gentleman feels so proud. He has everything happening through the artificial intelligence, and perfectly done. The coffee steamed at the right temperature. And then he said, let me get into the treadmill. So he got into the treadmill and he put himself at 16 speed. So he was going on well. And then he thought, let me listen to some music. So he asked the radio, play a nice music from the 90s. So the song started playing and he started walking and walking and walking. And suddenly there was this song, Summer of 69. And when the radio said 69, guess what happened to the treadmill? It was all again run by artificial intelligence, and this fellow had to fall down. So too much of artificial intelligence in your life can disrupt many things for you. That's what we want not to happen to us. And that's the reason why we are here. We believe in transformation, but nothing to challenge the human intelligence. So that's the takeaway. And the second thing that we would also be deliberating. So this panel discussion is very different from any other panel discussion, perhaps even IIMs would have not thought about it. And this panel doesn't have one theme. We want more. So this panel has two themes, and there is going to be an intertwining between them. So where we are going to discuss artificial intelligence, and we're also going to discuss governance. So the governance part, like you saw in the first session, ESG, which promised a lot of things. ESG is high on the agenda for all corporates now. And a discussion without governance, we would be failing in our duty. So we have artificial intelligence and we have governance with us. And that's going to be the theme for the second panel discussion. Both the panelists are expert in their areas. So with this note, I would welcome all of you to the second round of panel discussion. Please welcome my guests with a loud round of applause. I would also like to take this privilege of congratulating the Infinity team. They've done a great job, and there was an assignment which they had to submit, so we're extending the date for you. Apart from that, we have students, all, the young minds, and I can see also the undergraduate students, the postgraduate students, all brilliant minds. So I can assure you some great questions coming up. And huge thanks to all the students present here. And of course, our Dean sir, who's been year after year hosting this Privitti. And thank you, sir, for being with us. And for this session, he'll be proposing the vote of thanks. But otherwise, he's an expert, an institution by himself. So welcome to you, sir. So this is my introduction to the topic. And before I hand over to our guests, I would first like to set the tone for this panel discussion. So this is a 90-minute entire program. We'll be closing at 4 p.m. So we have the first and the second speaker talking about 20 minutes on their respective topics. And then we will have the questions from the students, or maybe perhaps we can have from the panelists also. And then at 4 p.m., we will be closing. So allow me a moment to introduce the first speaker. Our first speaker, Mr. Gaurav Sangani, is the founder and president of Jigyasa Foundation, a non-profit organization dedicated to education. He has been an entrepreneur and co-founded the e-learning portal CA Shiksha in the earlier years of e-learning in India. He holds a keen interest in tech disruption and its impact on business, society, and employability. He's a finance professional, a fellow member of the Institute of Chartered Accountants of India, and working as vice president for a global financial services company. I welcome him, sir. And once again, let's welcome him to the dais. Over to you.
Thanks for having me here. It's always good to take a session after lunch. You can blame lunch for sleeping audience. Hopefully, I don't have to. All of you look very alert compared to any lunch session I have taken. So thanks for having me here. I'm very grateful to the organizing team, Professor Evan, for having me here. It's a privilege always to talk to young minds and always to learn something. First, before I start, one disclaimer. Whatever I'm saying here are my personal view, not later any organization I will take. Topic is unique in a way. It's a role of AI in financial automation. It's unique in a way because everyone knows about it. I'm still going to talk standing here. And it's also unique because no one knows what's going to happen. So let's make it a little interactive. I'll keep my address a little short because I want to give a lot of time. And feel free to ask questions in between as well, after as well, on topic, off topic as well. Right? So feel free. We're saying role of AI in financial automation. Let's not assume that you know these terms. I'm sure all of you know, but let's break down these terms. What is AI? Artificial intelligence. Before we can define what is artificial intelligence, we need to define what is intelligence. Right? Human beings call intelligence when anything is able to perform cognitive functions when humans can perform. It's a very human definition of intelligence. That's the way we define everything, right? We define what is right and wrong based on humans. You can kill animals, you can't kill humans. There's no charge to murder animals. So that way, I think our definition of intelligence is very human. So let's keep the definition. If anything is able to perform same cognitive functions as humans, we call it intelligent. That's why animals are not intelligent. But what we call artificial intelligence, when a machine, precisely computer, is able to perform functions which we think are very unique to human. Right? I'm laying the ground. You may know all this, but again, we'll see why it's important for us for this discussion. What's finance? Let's keep it very broad. Wherever money flows is finance. If it flows in your pocket, how you manage your personal money is called personal finance. How corporates manage corporate finance. How governments manage public finance. So what is the role of AI in finance? How does AI comes into all the matters where money flows? That's what we'll briefly discuss. Again, we'll discuss broader things like stock market, all those things. But again, these are all different functions of money. So first, let's talk about what is AI. Have you seen AI in function? As Madam told, all of us have already seen AI in function. When you upload a picture on Facebook, it recognizes you. It's using AI techniques to identify you in a picture. When you talk to Alexa or Siri, it's AI recognizing your voice. AI can today draw, paint, do anything if you go. So ultimately, AI is able to do which we once thought only computers, only humans can do. Computers are able to do that. That's what we call artificial intelligence. So let's talk about how it's impacting kind of finance. First, let's think how AI works, and a lot of you already know, right? On a brief level, AI is when you train a model on a lot of data, it learns something out of it and is able to predict based on its learning. Do we know how does it work? Yes and no. We know there are models which can learn from data, but there's a scary part. We don't know how some of these models learn. There's a problem of explainability in AI. That's what I talk in some of my lectures on ethics in AI. We'll touch. I'm sure some of you will answer. No topic on AI goes without kind of threat to employability or ethics. We'll come to that if you have any questions. I'm not covering them. So let's talk about how does AI is going to impact finance world. It's already impacting. I'll touch 4 or 5 brief fields, and then maybe we'll talk about some of the questions. First of all, credit scoring. Any organization which is when it lends loan to you need to assess whether you're credit worthy, right? Some of the basic techniques are used as a credit score in any country now. India, all the scores, but it goes beyond that. With a lot of credits being granted in minutes now, today you can convert and raise EMI in minutes on even flight booking. How does it happen? At the back end, someone is running model which assesses your credit worth. Those things today are happening by help of AI. It looks at various parameters, including demographic, including income, a lot of different things, and assesses whether how risky it is to give the credit. Right? These models may go wrong, they may change themselves, but at the back end, AI is doing that. It will evolve in the future and will do more of that. Is it right, wrong? It has its benefits and pitfalls. Benefits, it can't be biased as human. Pitfalls, what if underlying data is false? Right? We know that. Let's leave it out, but at least that's where a lot of efficiencies are coming. If we can't use AI in credit scoring or allowing loans, quickly disbursement of loan, which is already happening. I think few years back, I used to say it will happen, but it's already happening. Micro loans are getting disbursed very quickly. It's only possible because we have designated or delegated the decision to grant loan to one of the algorithms. Fraud detection. Have you ever got call from the credit card company? Did you swipe your card? Some of us would have got, right? There's no person who is looking at all your credit card swipes. There are AI models which triggers, and now someone calls it says that okay, that person doesn't deal in that website usually. He's dealing. It's from an IP address we now usually not see, or some other parameters. So there are AI models sitting at the back end of your spending, your credit card, your apps, which is detecting this transaction looks fraudulent. How is it learning? It is learning based on the past data, and that fraud detection AI is playing critical role. Otherwise, assume there are millions of transactions happening every minute. It's not possible humanly to detect those. If you remove that, again, I'm not saying AI will come and sit in fraud detection. It's already sitting. If you remove today, it's not possible to have so many transactions at so minimal fraud detection. So fraud detection, AI has already changed the landscape. Algorithm trading. I wouldn't go in much detail, but algorithm trading existed even before AI was so advanced, but it's enhanced with all the AI. It can look into market, it can predict, it can look at different parameters across different markets. So it has empowered the algorithm trading. Robo advisors. Anyone heard of robo advisors? Robo advisors? Someone must have heard. Asset advisors, you guys know what are asset advisors? No? Asset advisors are mutual fund companies, right? When you give them your money, they invest on your stocks on your behalf. Those are asset advisors at the basic level. Then the asset advisors who manage your, like today we have a morning session, private equity, the private equity advisors, we have hedge funds, we have ETFs. Those are people who manage your money. That means you give them your money, they manage on your behalf, and you get a return, they get a share of it. That industry has seen a new entrance with the robo advisor. What does robo advisor means? There is no person physically sitting no portfolio manager taking decisions based on how the market is doing. We have algorithm settings which are taking those calls. What has happened? One advantage with these robo advisors are they can look at vast amount of data and decide or at least assess how they expect market to move. Same time, they're customizing products based on you, right? They're customizing based on what is your spending pattern, what is your risk appetite, what is their life goals. They come up with a unique solution just for you. That personalization is not possible if a human being is sitting there. So robo advisors have disrupted. They still yet to see that trend in India, but globally, overall, robo advisors coming. And another important reason robo advisors are disrupting, and when I say robo advisor, they are AI algorithms, actually data models, right? Another reason these are disrupting the field because the cost management fees has to be very, very low. There's no human being getting charged high salary which can. So robo advisors fees is very less, right? It is kind of time and again question that how these robo advisors will perform when markets are falling. Different questions are there. So they still need to prove their long-term viability, but they're already in use. So that's a robo advisors one area where AI has already disrupted the finance field and it's going to change drastically as algorithms get more smart, they will be able to take more complex decisions. Personalized banking, we touched in the morning today. You already interact with AI. Any of you interacted with AI on day-to-day shopping? You must have, right? So when you need to have, you have a complaint with Amazon, you go to app, you start chatting, you're not chatting to a human being actually. You start with a chatbot. It's an AI model. These AI models have evolved drastically. Earlier, there was yes and no question, and it used to direct your question to a real person. Now they engage you much more, and in future they'll learn more, and you will be mostly dealing with a chatbot. That has also disrupted finance industry, banking industry in a way that in your banking apps as well, you're directly dealing with a chatbot. It has implication of bringing down cost for the banks. It has also implications of customizing the solution for you. They already know where you may have an issue, where you may have a question. So some of those things we already see. Another thing is that they are offering product based on your spending pattern, based on your investment profiles. Those customization also possible only because of AI. Another area where not only finance, but other areas will be disrupted, already being disrupted, is process automation within an organization. I'm talking about finance, but finance deals with a lot of data and it's easy to disrupt a lot of things. First example, KYC. When you open a micro bank account, right, you have a lot of wallets which open your accounts in minutes. They verify your KYC in minutes. It's not possible for humanly to verify your KYC in minutes. It takes time. Someone will pick up your Aadhaar or something, right? But with some of the digital transformation from government with Aadhaar, with all the AI automations at the part of those companies, KYC has been majorly automated. That means AI model is verifying your picture with your proof and with your record. So AI has already disrupted KYC. Your robotic process automation, we talked in the morning, where you can train a robot to a manual function. Finance workflow is a very complex one. Let's talk about some of the workflows that you'll see in an organization when you go to finance. Let's talk some of those. Accounts receivable function. What do you do in accounts receivable? You issue invoices to your clients. When the cash comes in and reconcile, pretty manual process, irrespective of how big you are. When client sends a cash, he may mostly not tell his name. You may not be able to verify. He sent 10 rupees less than what was billed, or 10 rupees more. How do you reconcile? Huge AR function where companies are spending a lot of time. Same is account payable. Those processes have been primarily automated or will be automated in the future. Algorithms learn from past data to reconcile these two things, cash versus invoices. Accounts payable. OCR along with artificial intelligence has automated a lot of processes. Let's talk about equity research. As today we were saying that you can identify the potential private equity deals with market data. Private equity is still a smaller form. If you need to identify public listed companies whose data is out there public, their financials, that is changing the equity research landscape drastically. There are many other areas like auditing. It's a part of finance. Auditors are using already to find an anomaly. They are heavily invested in finding frauds, right? They can't test all the accounting data you give them, right? They have to find out sample data. Sampling is already through AI model, which tells them what are the high risk items based on the entity. They'll take your full general ledger and feed into an AI model. It will throw some of the samples which they need to check in detail. Regulatory filings. All the companies, especially this sector, does a lot of regulatory filings. You are dealing with tons of data and you are coming up with a regulatory filing. You don't know what may be in the data. Even if there's no fraud, what if there's something wrong? You are using anomaly detection to find out those items which need to be investigated further. Compliance, I'm sure we'll have a compliance session in a while. Compliance is AI is a huge role playing compliance. Companies are always struggling with surveillance, a lot of things going wrong. I know ethics was the topic earlier today. AI is going to play a crucial role. It's already playing a good role in terms of surveillance, trading surveillance, all those things. So AI is changing the landscape drastically. Risk management, all companies need to manage their market risk, trade risk. There's a wide amount of data out there. In this complex, voluminous data environment, it's not possible to manually track the risk. So companies already have those models which assess live risk while they're trading in the market. So risk management is where AI is playing crucial roles. So these are some of the areas. Again, I try to keep it very, very short. We can go in details. But AI, in essence, will be all everywhere, and finance will not be untouched out of it. Wherever there's large data sets, there are ways to learn. AI will play a role. I'll spend a few minutes because with this group, there may be a question, right? That means should you start learning data science? Should you start learning AI programming? Right? Some of you already doing. Some of you may be from a technical background, may think. I'd say no, it's my personal view. Not everyone need to be a programmer just because AI is disrupting. Same time, you cannot stay away from technology these days. That means you need to know not only AI, each and every technology into so much detail that you can at least provide solutions, suggest solution to your organization. How it will be implemented. You may be able to say, okay, in this problem, whether AI suits, blockchain suits, or something else suits, and how it suits, be able to justify it. And you can't do that just by reading an article or even by hearing my talk. You have to get deeper. You have to learn those models. Even if you don't learn to program, it's perfectly fine. You will get a programmer from a company who can do it. But that person doesn't understand functionally how things work. You need to understand your function very, very well. You need to understand how these technology work. And you need a third attitude, which is problem solving. That means able to combine two different things, how technology works, how function works, and come up with a solution. All industries, including financial industry, everything is going through drastic digital transformation. There's no looking back. Either you can be part of it or you can left behind. Only way to be part of it is contribute to it. And only way you can contribute to it is knowing your function, whatever your function, whether you're HR, whether you're finance, whether you're marketing, anything, knowing that in depth well, knowing these technologies well, and able to be part of digital transformation. I'll take a pause. There's a lot can be talked about AI. I'm sure you're already reading a lot. That's why I didn't go to a lot of details. But I'm happy to take any questions you have now, or we can take later as well. And, oh, sure.
All right, so that was one side of AI and its brilliance. We saw that. Of course, we are reserving a lot of time for the question answers that has to come up. Now, that's that side of caution we got now. Know your customer. Similarly, know your domain, know your function. I think that's one big takeaway you'll never find in any of these books. If you know your functions, I mean, the finance part or the accounting aspect or the marketing, once you know that, all you need is somebody who can program it for you. And for that, you have a technical person. And that's where we are, that's where it's a win-win situation. So the win-win situation comes with not just technology or not just finance. So when finance and technology get together, then we have a win-win situation. So like we saw, like the example also I gave you, the treadmill. The person did not intend the treadmill, but because the voice could not be read, the radio said 69 and started singing loudly, summer of 69. And you can imagine what happened to him. In the same way, this gentleman who fell down from his treadmill decided to go for a drink. And so he went out and he got drunk. And he got drunk, but he thought it's time to get back home because, ethical reasons. We have our other speaker talking more on it. So he drank so much that his voice went for a toss. So when he landed up in his doorstep, there wasn't anybody. Everything is, AI driven. So usually when he says, open the door opens. But this time he had a bad throat. Open the door. The door doesn't say character error. It's like, open the door. The door doesn't open anymore because he has lost his voice. And then he is looking for his keys. That is the time when his human intelligence has come into picture. But what he did was he left his keys inside the car and he said, car, you can shut down now. So at the end of the day, he lands up not getting into his beautiful home, which is completely driven by artificial intelligence. However, having said that, I just wanted to add a little bit of humor to that. But like very rightly pointed out, sir, the aspect of having artificial intelligence is inevitable now. And that's why we are here discussing it. We are in a VUCA world, definitely. VUCA was taken care just about some time back, but this is a VUCA world which is surrounded by volatility, uncertainty, C is complexity, and A is human intelligence. Come on, what is A? Ambiguity. So we are in that VUCA world, and in this VUCA world, where we have seen a little bit of artificial intelligence, let's invite our second speaker on corporate governance. He will be talking 2030, but let me have this privilege of introducing him. Mr. Gulati has a rich experience in corporate governance matter, conducting board evaluation and designing compliance framework for global organizations. He conducts regular training for executive and independent directors. He is a member of the Institute of Company Secretaries of India and has done executive learning from Indian School of Business and INSEAD. He is currently leading the compliance vertical in risk consulting practice of PwC and worked as compliance officer and company secretary in the industry. It's a great, amazing profile we have. Dear students, let's welcome him with a loud round of applause, please.
Audible? Thank you. So I've been sitting since morning, so I thought I'd walk around and talk. Yeah. So first of all, thank you so much for the introduction, and I want to thank all of you also because I had interacted with some of you, and it's such a humbling experience. I can say I visit campus. I used to visit campus a lot in my initial days for campus hiring, but the kind of humbleness that you guys have in each of the people I've interacted with, it's amazing. I can tell you, please keep it with yourself because you will need a lot in your career. So maybe can we have a big round of applause for all of you? Thank you so much. Thank you so much. So topic is, as Professor Vijaya was saying, corporate governance. And if I see corporate governance, right, and if I see companies as part of my experience that I have worked with, company is not always about profits. And when I say it, I mean it. Company is not always about profits, market valuation, and turnovers, right? There is a lot that goes in, making companies images and the positions that they have in the market, right? And, I can give you many examples, but simple example is just imagine a company, right? And that company has one insider trading issue. Insider trading, right? So one insider trading issue in a company and stock prices starts going down, right? And the trust goes away. Right? That's a simple example that how vulnerable the companies are, right? And that's where the governance is very, very important, right? governance, if you ask me, it's a hidden force behind creating those images of the companies or the positions that companies have, right? So that's the power of corporate governance, right? But I can take a step back and I can quickly tell you that where all it started before we start diving into, what is corporate governance and what are the elements of it and how it is currently happening, what is the future as Professor Vijay was saying 2030, right? So I'll talk about the future also, but let me give you a quick glimpse in terms of where it all started. So if you look at corporate governance as we see it right now, globally it started somewhere in 1970s, right? And in India, if you see the landmark thing that we observed was KM Birla Committee of Corporate Governance. They provided some landmark, suggestions to industry, which got implemented, and it was supplemented by Narayan Murthy Committee report. I think these are beautiful reports. If you want to look at really the history of corporate governance, read these reports, right? So Narayan Murthy Committee report presented the corporate governance structure along with the KM Birla Committee structure. That's how in India this concept started. While Companies Act 1956 was always there, right? And there were a lot of central government approvals, that were required, for the governance matters, right? But what these reports did, first time in India, we saw the CEO and CFO certifications. So many of you will become CFOs in future, right? Many of you will become, CEOs in future. So there is a CEO CFO certification that was introduced in our country, which said that every financials needs to be certified by the CFO and CEO, which means what regulators are saying. They are saying that the executives and directors are responsible for what they are doing. Clear. They made it very clear, right? And this is, I think, the world that we are in also. When I explain the present, I'll tell you that how current government is, treating, these governance aspects. But that's how the Birla Committee and the Narayan Murthy Committee actually started with. And then came the Companies Act 2013, which actually laid out the very structured governance approach for our country, right? And there are disclosures, there are many compliance norms that they listed out that how companies will move in terms of governance. One of the example, you must have read also because I deal it on a daily basis is a director responsibility statement. It's part of the annual report of every company in India, be it a private company, public unlisted company or a listed company. Every company has to come out with this director responsibility statement, and directors has to certify that there is a risk management process, there is a compliance process, and there are many other things they are certifying. Again, the same thing. They are saying the people who are at the position, they have to take the responsibility. Right? So again, Companies Act 2013 also laid out the similar thing. And very recently, Kotak Committee recommendations on corporate governance 2017. You guys must have read it, right? It's a beautiful piece. If there are many pieces in that where still corporate India is struggling to implement it. One of the things that women directorship in India, they said that we need women directors, we need female participations in the corporate India. Otherwise, with this male-dominated society, we will go somewhere else. So they said we need women directors. That's the landmark thing that Kotak Committee recommendations did. One of the things which is still not implemented is splitting the role of chairman and managing director. Right? You must have read in the newspapers, right? So this is still one of the things that they say that we need to move away from a promoter-driven regime, right? They say we need to look at the scenario where independently companies are running, right? So that's why they said the concept of splitting the role of chairman and managing director. Right? So those are and I'm sharing very few because we have limited time, but read these reports. Kotak Committee report is one of the very good corporate governance report that you will see the way India is moving, and maybe some of the few future reports will come in, which will shape the way that we see corporate governance in our country, right? But that's how it is happening. But I see I would say a bad side of corporate governance also, because what is happening because of this corporate governance, and I would say this is the biggest failure of corporate governance that has happened, is that companies are being judged on a very short-term basis. So say, for example, if there is a failure, they say this is bad, just shut this, right? So what board of directors are not able to do, they are not able to focus on their long-term vision, right? So that is the problem that is happening right now. And we were, I think, in the first session discussing, there are many companies I know, they are converting themselves into private just to focus on the long-term vision, right? So this is one of the things that I think as an industry, as regulators, I think we need to address. that we should give some liberty to the board of directors that they should focus on the long-term vision. So that's the flip side of it also, the way it is happening. But if you look at current scenario, the way I was saying it, look at government of India. If you are reading, and following this topic, look at what government of India is doing. Government of India is saying that if there is a failure, I will catch hold of the watchers. And when I say watchers, I say independent directors and I say auditors. Right? Obviously, the board of directors and everyone is there, who will be get caught off. But they are saying that independent directors. So, very recent example, if you have read, they have said that all related party transactions would be approved by independent directors in the audit committee for listed companies. Right? What it means? They are saying related party transactions are the transactions where most of the frauds start happening, right? Because some people will find some vendors, some people will find some relatives, and they will give their contracts to those people, and they say that you do it. That's where all the fishy things starts happening. So they say we don't trust executives, we trust an independent director. So can you go and verify that all these transactions are valid and come back and tell us that it's all okay? So that's where the government is moving into that direction, right? So they are saying we give liberty to independent directors, right? I also come to the independence of independent directors when I go to the future, but this is what right now it is happening, right? So it is a very situation where government is not tolerating. It's a zero tolerance policy. They are saying if there is an issue, we will find it and we'll stick it, right? So where we need to actually go from here and how can we look at it? So we went to companies. So we did some surveys with many global directors and many Indian directors, and we asked some very specific questions to them that what do you feel about it, with this governance concept? And we asked, and what are the risks that you see for your businesses? So they came out with 4 answers. And I'll go one by one. They said first is talent retention. That's the biggest issue that we are facing right now, and they were facing, and this is still not solved. Because in current market scenario, the talent retention is the biggest problem of any board, and they are struggling with, right? So they are looking at bright talent who can actually come into the company, but they don't know how to retain that talent, right? So that's the current market challenge. Right? Second, they said digital transformation, right? Second is the most important thing. I think this has been discussed. Every board of director, when we talk to them, they are saying everything that we are doing, there has to be a digital play. We won't do anything where there is no digital play because we can't do manual things anymore. Because businesses have grown so much, right, that manually it can't be managed. So digital play has to be important, right? Third, they said cyber security. Cyber security is the biggest concern for many of the boards. Everyone almost said that, while we have policies in place, while we have structures in place, but we are still threatened by the cyber attacks and the cyber issues that will come for our companies, right? So that's the third risk that they identified that we don't know how to handle that issue. And the last one they said is the ESG, right? Which is they say that while global pressure is there in terms of making us climate friendly, but we don't know how to handle this part, right? So it is a very, while everyone is saying ESG, but actually it is a practical difficulty to manage those scenarios. In fact, I can give you some data points. When we did this survey, so almost 45% of directors believe that the ESG issues actually have an impact on company's performance. Can you imagine that? So they are saying, so it means more than majority believe it will not have any impact on company's performance. If you look at it on the flip side, right? So they are saying businesses will go on, ESG issue will come and it will go, but businesses will go like that. In fact, I can relate to Nirmala Sitharaman, our finance minister is out of India, and she has made a statement, if you have read it yesterday. She's saying we are coming back to coal. Have you read it? She's saying we are coming back to coal because we can't sustain with gases because it is too expensive, right? So let's see where it goes. So practically, actually, many people are calling it where it will go, but let's see where it will go. So that's where the board of directors are also struggling, that where ESG will go. Second, 56% said that they understand the company's carbon emission. So that's, so when we talk about ESG, we first come with the carbon emission, right? So 50% only knows that what is the carbon emission of the company, right? Half they are not aware even that what is carbon emission for the company. If they don't aware what is the carbon emission of the company, how they will curb it, right? So that's the situation currently. So that's what I was saying, that why this is a concept where directors are struggling. So that's where the current scenario. These are the top 4 risks that came out when we talk to board of directors, that what is the issue that is happening on ground. And if I talk about the future, and the first one is, which I mentioned, is the independence of independent directors. It is very important, and you will see a lot of regulations, will come into this place, because globally, independent directors are playing very critical role in defining strategies even, and critiquing the strategies that companies take. In India, it is not happening. In India, if you look at, it's an insider approach, right? So mostly if you find directors, they are promoters, right? They are promoters of the company who are directors. Even independent directors are getting appointed by promoters, right? So that's the state that we are in right now. But there is a lot of this, even SEBI has already placed a suggestion where they are saying we need to create this independence of independent directors. And how they are doing it, they are saying give more power to minority shareholders. Right. So when the independent directors are getting appointed, so they are saying bring the say of the minority shareholders, so that the actual independent person is becoming an independent director, right? Which will solve a lot of things. So India has to see this journey, and in next 5 to 7 years, you will see that. You will see regulations. I'm personally working on a recommendation paper with one of the industry body, which will go to SEBI, and this is one of the topics we are working on. That how we bring, there was never an independent, but we are saying that how we bring the independence of directors, right? So that's the one topic you will see in future. Second is board diversity. I think when you say diversity, we typically see that it's a gender diversity, but it is not the case. Diversity is a larger topic. When we see diversity, gender is one part, age is another part, then there is expertise that you have, and the tenure that you have spent in the organization, it is also diversity. So how diversified is your board, and structures that will define the board diversity. And if you look at the current boards, if you follow the board of directors profile, if you follow that who are the people getting appointed in directors position, you will find that 90% of the people, either they are very good in operational and business skills, or they are good in financial skills, right? Which all of you are, right? So 90% people are there in terms of that, but this is getting changed now, right? Because there are more and more new risks are arising, and boards are getting diversified. So there are people with cyber expertise are inducting in board. There are people with human resource expertise are coming. There are people with climate, expertise are coming. So the future of board would be very different. It will not be pure play people who understand the nuances of operations or finances. It would be multi structured board. So that way, as finance professionals, and I'm talking about future, here. So as finance professionals, you have to enlarge your vision and see what is happening around you, because finance relates to everything. Finance is core, but then there are things over and above that, right? So that's how the current structure of the board is also happening. Third is board evaluation. That's the third thing that you will see happening in India big time. And I'm saying it because you will see a lot of changes. Currently, the boards are not evaluated the way they should be evaluated, right? Globally, in UK, in US, in other countries, there is an independent agency who comes to the board meetings. They observe board meetings. They make the evaluation that how board meetings are conducted, and then they meet the individual director and assess that how board meetings are happening. So that's the board evaluation that is happening for companies outside India. In India, it's just a tick mark exercise right now. There are some questions asked. You say that this is done, this is not done, and there is a scoring mechanism which is coming out. So the future would be that stakeholders are now more asking that how board is performing. Give me that report. So if I'm investing in your company, if I'm an investor, if I'm a stakeholder, then I want that report that where it says the evaluation. So you will see a lot of transparency where boards will come out and say that these are our shortfalls. Like no one is perfect, right? So these are our shortfalls. These are our improvement areas that we have identified. And this is how we are monitoring it year on year. It is already a disclosure in the annual report. If you read annual report of any good company, you will find the board evaluation, performance evaluation section. But those sections will going to be very, very elaborative in going future, right? So that's the section, you can watch out. It will evolve a lot. And the last is trust and transparency. So if you look at the current world, US is in recession. See what is happening in Europe. Look at the Russia and Ukraine thing. And Mr. Mohanty was talking about Taiwan also, right? So look at around what is happening and where is the trust equation going? Trust equation is actually shaking if you look at the current scenario. But there is other flip side to it. If you look at corporations are now looked at as an agent of stability. So people are actually trusting on organizations, right? So that is the change and the mindset change that is happening right now, right? So in fact, there is a report, which says, and I can quote that report, which says businesses are the most trusted institutions in America, right? That's the situation that is globally happening, right? Because everything else is shaking, right? So where to fall back? So that's the scenario. And if that's the scenario, from a governance perspective, what boards and stakeholders have to do, you will see a lot of dialogue that will start happening between boards and stakeholders to create that trust equation, to manage that trust equation, because future is of the corporations, right? So that's how the governances will shape up. And I maybe pause here, just with this trust message that this is what we need to create. But I think we have ample time now for the Q&A, and we can dive into each of the topic where you want, and I will encourage you to ask as many questions that you can ask. Thank you so much for now. Thank you.
Thank you, sir, for this pertinent discussion on corporate governance in the Indian parlance. This marks the opening of the question and answer session. The floor is now open for questions.
Good afternoon, sir. Myself, Prachi Dhar from Bachelor of Commerce Finance. My question is to both of them, either of one can answer. So the banking and financial sectors are backed with a lot of strict regulations and other things. So I think that with the coming of AI, the regulatory reporting won't be that transparent. So what's your take on this?
So when you say it will not be transparent, what do you mean by transparent? Because regulators only see a report. Nothing is still transparent to them, right? So what do you mean it's not
I want
transparent?
to know more on the topic because before it was very traditional and a fair play was seen. But with the coming of AI, how will this be affected?
Yeah. So I think to regulator, your regulatory reporting is still a form that they have asked you to fill, right? At the back end, you have systems which populate that, humans which check that, analyze that, and submit that. Where AI will come is, it will give you additional hand in analyzing your regulatory reporting. If today I have system where there are 1 lakh line items, you summarize into a certain items which your regulator is asking, you submit it, right? You have limited capability to find out error there. You can do your traditional analytics and figure out. AI will and is sitting on top of that and giving you additional data points to investigate. I don't think anyone is doing or will ever do put an AI which will do a regulatory reporting. It won't happen. It's too sensitive and too risky. It will add as additional tool to give you anomalies you can investigate. So I think the quality of your regulatory reportings in any case is going to go up, not down as such.
Thank you.
Good afternoon, sir. I'm Saujanya Hedvipur from first year Master of Business Finance. First of all, thank you for such an insightful session. My question to you, Mr. Lokesh Gulati, is that internal conflicts and corporate politics, and how does it affect the corporate governance of a company?
It's a political question. See, corporate governance as a subject, as I explained, is a subject of regulation and management of compliances and doing things ethically, right? So that's the subject. When you bring politics to it, you can bring politics anywhere. You can bring politics here in this institution also. You can bring politics right now also. You can bring politics everywhere, right? Wherever you bring politics, you will defeat the long-term objective and the outcome that you want to derive from that particular thing, that where you are bringing politics. I'm not commenting that there is politics in corporations, and there is politics everywhere. I find, maybe it's, I think, human nature that we are bringing politics everywhere, but wherever we bring it, the long-term objective would be defeated because we'll be diverted to some other things. So my idea is, because politics is such a thing that, either we do it or we don't do it, right? And that's how we live it. In corporations, there is politics. In regulators, there are politics. But the lesser we do it, I will not just, stop it because it's a very large statement that stop politics. Lesser we do it, easier we will achieve the long-term objective. I would say.
Good afternoon, sir. I'm Akshat from first year Master of Business Finance batch. And so my question is to Mr. Lokesh Gulati. So you talked about talent retention. And so we can't ignore the fact that attrition rates are at an all-time high now. So, sir, what measures are being taken by the big players, so to speak, in order to, curb these rates? And also, are they running the risk of being toppled by the smaller players in the market, so to speak?
Elaborate the last one, the smaller players.
So, because the potential employees, they are preferring to work for the smaller players, and they are like the attrition rates, as I mentioned. So, if this trend continues, so are they running the risk of being,
So if I see talent retention, and there is discussion on talent retention at everywhere, like I mentioned already. There are 2-3 things. One is historically the way talent retention is looked at, or the way talent is looked at, right? One is historically we have seen in India, I'll talk about Indian context right now. India, there was I would say, lesser of talent and lesser of opportunity. I would say more of talent, but lesser of opportunity. Now the opportunities have increased so much, right? So the talent, there is a lot of option, like you said, the smaller and the big players, and within those also there are many options. So what companies are doing right now, it's very easy to say that this is the money that we are giving and that's how the talent would be retained, but that's not the question anymore. What companies are doing differently, they are saying, they are telling the talent that what is our value, what is our objective, and why you are working here. It is more important than giving a more money. While money is also a critical factor, right? No talent would be retained if you are not giving at part, compensation. But if they are attached to your objective and vision that why this company is running, and if the talent gets attached to that, the talent will not go anywhere. Right? So this is the one thing, at least the companies that I work with, I have seen differently companies are doing. They are not talking about anymore that you pay higher compensation and then how you retain the talent, because higher compensation are available otherwise also. But are your people actually linked to the vision that you have for the company? If the answer is yes, it will stop.
I think it's very interesting. I couldn't hold myself because as he was saying that, and for us, like, for major multinational companies, like, because now smaller players have come in and they have started paying really well. The startups and all have started, and we were discussing the other day that the startups, like, to name a few, I would not name a few others, they have started paying really well because that's the way they can pull the new talent. But the way we are doing, the multinationals is giving a lot of benefits, in a lot of ways, like, insurance and trainings and, family time. We give a lot of flexible hours prayer time. I think that is one of the biggest, I mentioned about this earlier, that these days people do ask that are we, this is the hybrid model still on. I think that's one of the way to retain talent, and that's where people are attracted towards these multi MNCs as well, rather than, those traditional companies who are not so employee friendly. And I think so any type of employee benefits, and its employee benefit is a very large term. I mean, if you just Google it, you'll see that there's so many employee benefits, and which generally these multinationals give to retain the talent. I think that's one of the core area where when these have come up, to retain talent. At least, I was just mentioning the other day that maternity leave have gone from 3 months to 6 months. Some are giving in a year also. We have paternity leaves ranging from 4 weeks to 8 weeks. So, these benefits really retain, it's not just the money, as you were saying, which drives a person, there is something called as comfort level, somebody who is more comfortable with the environment, with no politics in the, if you have a good team, you got to retain talent, so sometimes those are the driving factors. People don't just, money is just anymore a driving factor to, because you just upgrade yourself, your luxury will increase, but then ultimately you will not have peace of mind. I think that's what everyone, we have to kind of think about it, dwell about it, once we start working. So yeah, that's it.
It's an interesting topic. So everyone there's a competition, right? So say 10 years back, there was only Lay's chips you could buy, right? Today, smaller brands can launch a chips brand and can compete with Lay's at any level, right? Is there a way Lay's can avoid that? It's not possible. We say word is flat, but word is more competitive. So big corporates cannot avoid the competition from startups. When it's small players, they pay well. There are people who will join startup for sure, not only for pay, but the sheer joy of working with the founders, with that kind of intense. But it won't suit everyone. There are people who want a big organization to see how it works. So I'm same way. I think the world is getting more flat, more competitive. We need to realize or accept that those small players will disrupt the talent market. But there's a niche where there is a population which may want to stay with big corporates, same way as startups. I'm saying there's a fair place for everyone to hire talent and retain. Everyone will have different preferences and there are different advantages. And as in we're looking at this side. At that side, you're also confused whether to join startup, corporate, start your own startup. Everything has the pros and cons. So I think, yeah, so I think there will be talent for everyone and there will be competition going forward. World has become more competitive for products, even for talent.
Talking about talent retention, I think, and this is for all the girls out here, companies are now taking this initiative of providing egg freezing as a talent retention policy. It's part of your HR package now. So egg freezing is something which is very new to India actually, but Apple and Facebook, they started sometime in 2017, where they said that the best age for a man and a woman are the same. But when the woman is at the best age, that's also the best age when she has to start a family. And that is why they said that you join us and we'll take care of your egg freezing policies. We'll pay for it. It's cost about $20,000 and it's a process. Women are shying to take leave. For example, if I want to take a leave, I have to state the reason why am I taking a leave. But the HR packages which are being now offered to women so that they understand that I can retain my job and I can also, my HR is supporting me. So this is, India has to catch up with all these things, but it's happening. And so it's a shootout for all these talent retention things that companies, it's not just about the ESOPs, it's many things beyond that. Any more questions? Yeah.
Good afternoon, sir. My name is Vedant Das. I'm from first year postgrad pursuing Masters of Business Finance. First and foremost, thank you for such an insightful session. My question is for Mr. Gaurav, sir. It's regarding the AI and algorithms. So as far as AI is concerned, it looks back at the past data and accordingly one has to design and the analysis steps. But if you look at the algorithms, they are customly designed for and where the defaults work is rectified. And as to state a very popular event which everyone recalls, I believe, a few years ago, Facebook shut down the two AIs because they started talking to each other in a language which wasn't evident or which none of the human beings could identify. So my question to you would be, why not use algorithm more as it can be easily customized and the defaults won't be there, rather than more putting emphasis on the AI part?
It's an interesting question. Let's start with on a lighter note, right? If you go to a party and two people are speaking a language which you don't understand, why do you doubt that if they are talking against you? Won't shut down. That's a diversity issue, right? Why not against AI? So why did humans assumed in that case that AI is conspiring? We are too afraid. Right? That's the reason. On a lighter note, but I'm saying algorithm is one, but I'm thinking there's a limitation to how much you can program algorithm. That's what you're saying. I think you decide what algorithm decides, which is a traditional algorithm. It has its own limitation, which we already see. So AI is the next step or further steps from there. It has to learn on its own. Can you build a image recognition system based on algorithm? Never. You can't put so many data points. So I'm saying traditional algorithm has its own limitations. And I would be saying, okay, but we have to come over the limitation. We have to, but we are 5 years ahead of that. I'm saying there's no way to go back. Whatever you already achieved with AI, you can't achieve that with traditional algorithms. You can't program that. So I'm saying we have crossed that bridge 3-4 years back, and pandemic has accelerated that. There's no way going back. I think that question, even if we want, we can't go back now.
Thank you, sir.
Good afternoon, everyone. My name is Vishal Pradhan. I'm a second year BCom student. And, my question is for Gaurav, sir. Sir, what are the ways for fraud prevention when we're using AI in the financial industry?
See, again, simplest form. Again, that's what I'm saying, that we need to see what AI can do. AI can learn from data and it can predict the data. In case of fraud detection, it can predict that data is out of normal norms. It looks odd. If it looks odd, doesn't mean it necessarily a fraud. It triggers, which you need to verify. I said that it may trigger that Mr. X doesn't do a trading from this terminal or doesn't do card swipe on this card, or he has done 10 swipes in last 15 days. He never does that. So those are the indications AI can do. It will get smarter with the time, learning from your spending pattern, learning from others, learning from its own mistake, right? So it's a feedback mechanism also built there. So it can put out that. So ultimately, AI is giving you predictions. It can predict that this looks out of ordinary, and you need to investigate. I think that's the role of AI in any case. Fraud detection, when you put on a lot of financial data, it can alert you. But again, doesn't mean that alert will always be right, but at least it's a good alert. It's a good indication that something should be checked. I think that would be the role of AI going forward. With time, it may get more power. Companies may start blocking your transaction automatically if they are very sure of the model, if they don't have capability to deal because financial transaction are increasing. I think that will depend from company to company, industry to industry, how much autonomy we want to give on AI. But that's a basically at basic, that's what AI can do, and that's how it will play a role in financial fraud detection. Thank you, sir.
Just an example to what this AI can do and what Gaurav articulated. So recently, I'll not name anything, but recently there was one fraud detection work happened and there is a RPA that was conducted, and that RPA actually went and read the source of the document. So say for example, it's a Microsoft Word document or it's an Excel document, where it generated, who generated that document, and where the origin was, right? And the RPA actually looked at all the invoices that were coming from vendors, right? And when the RPA looked at the vendors' invoices, they realized that majority of the invoices are generated within the company, right? And that also realized that in which computer it was generated. So you can imagine what would have happened. So that's the power.
Is it also true that most of the IT frauds happen inside the organization by the person who is passing the entry and he knows, and also like the trick that you said that anything that is unusual is taught by the artificial intelligence. So if I'm a good hacker, I'll avoid those mistakes which the artificial intelligence will catch, and then I'm an insider. I know what my system works for. So where do we lead to then?
There's a good and bad. There's one thing which is you can say good or bad about AI is no one knows how it works. That's the biggest question in ethics AI. I've been taking that lecture for some time. It says that unexplainability is AI's biggest problem. So it's a bad because you don't know how it works. So it's a risk. Same time, it's a benefit. No one can know how those models are built. And then you have to tweak that models. Those models should be built in a way that they evolve with the time. So AI is playing a crucial role in cybersecurity because cyber criminals know a lot more because a lot more on stake, right? But if you put AI models, they change themselves so frequently that you can't. So that's a good and bad part. Does it mean that people will not be able to break it? No, people can break most intelligent code, but there's a lesser risk than manually programming certain codes. So I think the option is do you do it traditional way or AI way? Certainly AI way data learning on its own going to be more beneficial in future. It may have some pitfalls, but in future I think that's the way to go forward in for that.
Good afternoon, everyone. Good afternoon, the panelists. So my question is to Gaurav sir. As you stated about the inclusion of AI with finance, as it is happening in the recent years. So is there in any way that we can assess the risk and totally eliminate it in the investments that we make?
Okay, let me rephrase the question. Tell me if it's right. You're saying that can AI help you eliminate the risk from your investment?
Exactly.
By definition, then it would won't be investment, right? So if there's a no risk, you're not able to gain anything at all. So I think by definition, it wouldn't be investment. That means what we're saying that AI can predict that if you buy X stock, it will certainly go up. Let's keep AI aside. Do you think there's any possibility it can ever happen? There's no possibility. I'm saying that the question itself has inherent problem. If there's no risk, there's no way you can going to make a more than decent investment, right? Government bonds don't have any risk. You make a decent investment. So yeah, it's not an AI question. It's a basic philosophy of investment. There has to be certain risk. See in a way, when you make money, someone loses money. That's how this financial world works, whether you like it or not. So there has to be risk. I think it's a fundamental nature of the investment rather than a AI issue.
Thank you, sir.
Good afternoon, panelists. I'm Sibanjan. My question is to Mr. Lokesh. Primarily, we see in India that the businesses are family owned. And what's your take on the corporate governance aspect of family owned businesses? That's question one. And if at all it has evolved with time, because family businesses are primarily private businesses. Very few we can say that we have listed companies and family backed businesses.
But primarily in the private side, I want to understand whether the corporate governance issues have been imbibed by these private owned family-backed businesses.
So I deal with a lot of family-owned businesses as part of my job, and I have seen a trend that these family-owned businesses, especially the promoters, are taking a little back seat and they are bringing professionals into the companies, big time. They are saying the CEOs of the company and the CXOs of the company has to be professionals because they will drive the companies. And I can take you many examples. You can take the example of Haldiram, you take the examples of many other companies, right? They are bringing professionals and they are saying they will run the companies. And we will be there as either advisors, we will be there as in the board of directors, but we will not run the companies, right? So this is the change that has already started happening. It is happening, and in most of the cases, it has already happened. Advantages they are seeing in doing that, the way they looked at, because there was an idea, right, which these promoters saw and they see that and the results came in. But now it's a time to amplify that idea and bring to the next growth strategy, which promoters have realized that they have to bring professionals to run these businesses. Then only they can multiply and manifold the business that the potential of the business is. So this has already started happening. And with professionals coming in, you can't avoid corporate governance because they are like all of us are professionals, right? So if you say, for example, bring one of us to any company, this is seeded in us. While there may be a tussle between a promoter and the professional, that's another thing. But that is seeded in professional the way to work in business, right? So corporate governance will be, or this is happening. I'm not saying it will happen; it is already happening. Thank you.
Good afternoon, panelists. I'm Aditya Mahapatra, second year BCom student. I have a question for Gaurav, sir. As you mentioned about AI and also touched upon blockchain, the first thing that comes to my mind when I talk of blockchain is decentralization. Could you please explain and shed some more light on how AI and blockchain can improve customer rights on privacy?
Yeah, see, blockchain is most used and sometimes slightly most abused word as well, right? Blockchain's popularity is the biggest enemy. And I'll tell you why. I started my speaking journey with blockchain itself. And then when I used to say that blockchain is exaggerated, no one liked me because people thought it's going to change the world, right? But I'll stick to the privacy thing, right? Let's talk about Bitcoin or any cryptocurrency. There are benefits of cryptocurrencies and there are huge downsides as well. But one good thing is it has anonymity. You are identified by your public key. You don't have identity there. And recently RBI came with a concept paper of government issued digital currencies. And they have questioned there that whether the retail digital currency should have anonymity or not. And they concluded in a way saying that it should have, which is surprising for government organizations to say that we want anonymity. They're saying that if we don't put anonymity, that means if we can know who holds the digital rupee, it will not be able to compete against cash, which is right. That means they're accepting that somewhere cash has advantage of this anonymity. See, what's the irony? That was the whole point of demonetization, right? But they say that to limited extent, they want digital currencies to have anonymity so that they don't have a disadvantage of physical rupees. So yes, blockchain brings privacy, but there are certain limitations where you can use privacy, you can't use privacy. Government may not be able to allow you to trade in company's stock. There are blockchain concepts where you can do a stock trading on blockchain. But can they allow you anonymity there? Does government want that they don't know who owns 51% shares of Reliance? No. So there's a limitation. And this is some of the biggest problem, right? Because Bitcoin is anonymous, it has been blamed a lot of time or other cryptocurrencies of being used for illegal purposes. We're living in a society where I know we want freedom and blockchain will change anything, but it has its downside when you allow something to operate without any government organization. We want decentralization, but that also brings a lot of downfall to a civilized society. So yeah, it provides anonymity, privacy, but its wide scale use has to be limited because of certain constraints.
Good afternoon, panelists. I am Jigyasa from MBA second year. My question is to Mr. Gulati. So you mentioned about how only 45% directors feel that ESG affects their business, and how our finance minister also mentioned that we'll be continuing using coal. So what is your viewpoint regarding the future of ESG governance, and how is there?
If you ask my personal, viewpoint, we need to see where it is going. It is not clear, right? Globally, there is a lot of talk about ESG, but the way things are moving, I think we need to clearly watch out that how. I'm not using some words that where this ESG will go, but we really need to watch out because because I personally conduct ESG reviews for companies, right? I do ESG framework designing. Some companies are doing it just for doing it. They are saying because there is a requirement, because now in 2022, my business responsibility reporting has to go, so I have to do it. But is there because ESG is as a concept is a value driven concept. Are your values aligned to what you are saying? Are you really want to do the carbon emission lower? Are you curbing your travel that is happening? Are you analyzing that this work can happen without travel? Are you analyzing there are a lot of other things? So if you ask me, from a corporate standpoint, it has to be seen that how it will evolve, or they will just do some paperwork and they will stop. From a government standpoint, they are realizing now, which is clear with the evidence of yesterday's statement of Nirmala Sitharaman. It's a landmark statement in this scenario, if I say so, and it will see, and there's already a lot of reactions coming to that statement. If she's saying that we are coming back to coal, then where is this concept all about? So it's a question mark again, back to square one, that what we are doing in this space. So India is actually raising a question on the global developed economy that you are saying ESG, but we are not able to sustain that concept to run it locally, right? So we need to see where it will go. So that's my answer to it. Yeah.
Good afternoon, sir. So my question is for both of you, Mr. Gulati and Saltani. So we spoke about talent options. We also spoke about AI and robotics. In 2019, our Honorable Prime Minister, he told that maybe by 2024-25, we are going to reach the 5 trillion economy, if possible. So since AI is growing so much, we see that everything is happening in an automation way. Banks have also edited the AI, fintech are coming, digital banks are coming up, and it is taking over almost every industry. So is it it's a two bit, so is it gonna affect the choice of employment in the near future? And is there going to be a balance between both of them, AI and the employment opportunities?
No discussion of AI is complete without threat to job loss. So, and it's very pertinent, right? And it's what we also think. Okay, I'll ask you a question. Do you think ATMs have taken away jobs? Yes or no?
Not exactly.
Okay, good. So, what does ATM do? You go and withdraw cash. We have seen the time when ATM was not there. We used to go back. There's a person called teller. You'll give him a withdrawal form and he'll give you cash. Today, if you remove ATMs, you have to put lakhs of tellers in banks, literally lakhs of tellers. So tell me, have ATMs taken away jobs or not?
Yeah.
Okay. So are banking jobs less or more?
More.
Multiple times more. So technology takes away jobs for sure, but it takes away specific jobs. It don't take away jobs generally. It creates jobs, right? And there was a question, I was doing a webinar a couple of days back, right? So when you put a automation process, right? You are doing, suppose you're downloading a data, you're crunching number and preparing a report. It takes you 8 hours. Tomorrow, and the person was asking me that, okay, if my company puts a AI algorithm to do that, that means my 7 hours are saved. That doesn't work like that. The company will not tell you go home in 1 hour, right? What will they do is, if you are doing that process manually in 8 hours, now you do in 1 hour, they'll give you 8 processes, which is right. But are you seeing what is happening? Company's productivity for that process has become 8 times. Smallest example. So ultimately, that's how technology brings productivity, efficiency in the economy. Companies grow. What is a banking job? Because it's easy to open bank, easier than when you had to do everything manually. More banks have come into the picture. More branches are open. You can see branches all over, or ATM machines. So overall, banking jobs have increased. To answer your question, I think I'm coming around. But ultimately, AI will bring productivity into the economy, which will create more jobs than less. So your question directly was that company will choose between an AI or human employee. They don't need to choose. Where AI can do, they'll choose AI. Be sure, right? And you cannot do better that job than that in AI for that job at least. It's not possible. Humans will do something different. I'll say, okay, there are thousands of customer care executives who might have gone out of job because of chatbots. But customer care jobs are not gone away, right? You still need a human person when a customer gets angry on a chatbot. You must have got something. What is it? I want to talk to a human, right? Just that customer care executives have moved up the value chain. If you could answer simple question, customer care job is gone. But if you can handle an angry customer, that job still stays there. AI can't handle that. So companies will not have choice. Where AI can do the job, they'll certainly choose AI. You don't need to worry about that. But there are things which AI is not able to do and will not be able to do in foreseeable future. They don't have choice. So jobs will grow because economy will grow. You will go up the value chain, which is good for you because you're doing a much valuable job than crunching numbers.
So yeah, adding on to that, it just gave me an idea because Mr. Gaurav, while you were discussing, you spoke about robo advisors. So, and I also heard Tilak's question and this idea about getting a job and upgrading. So being a board of director is also a job. Now, can there be a robo advisor that the board of directors can use to enhance their position? This is for both of you. Because
It's a tricky one. So I think I'll not comment on robo advisor, but I'll talk as a tech as a whole and how tech can help board of directors to take certain calls. That's your question is all about. So it is happening already. There are some tech tools are already there who are helping even conducting board meetings, in conducting annual general meetings, in crunching all the day-to-day affairs that he was just referring, preparing minutes, preparing agendas, everything is happening automatically, right? So people are not spending time in preparing that base level data. What people are doing, people are actually what should go into that. They are spending time there. And board of directors are getting some data through these algorithm, through these tech platforms, that what are the decisions they have to take. Because decisions in current scenario, still humans are taking all major decisions. Technology is helping them taking those decisions, right? So lot of crunching which is happening previously by manual intervention is getting automated, and that data is readily available. Now look at that data and take decision. That's what the job is currently at many places are being happening that way, right? You talk about Power BI, you talk about many other tech data driven functionalities. So everything is being done. Look at it and take decision. Now that is still humans are doing, and I think we will continue to do that. But in some cases, even they are saying that decision making is also, let's leave it to the AI or other tech platform. But how mature would be those decisions? Because if we talk decision making at board of directors and others, typically it's emotion driven. If you look at decisions, humans are, so if sir, like sir was asking how professionals are and then how family owned businesses are. If one Lala decides that I have to open this business today because he feels that this business will grow, maybe he'll have all data which is against that, but he sees that this business will grow in India. So that's the bet he will take on that. And that's what he was talking about, the risk that you need to take in the investment. So that risk and decisions will, I think, still remain with humans, but there will be a lot of things that tech will do and continue to do, and we need to be really up on the game that how this is moving. Yeah. Yeah, big time. Right, sir. Thank you. Thank you. Packages in a sense?
Supposing I'm a director of the company, so where do I get these things?
There are many. There are many. I can go on, but there are many. Yeah.
Affordable prices.
Affordable prices. Depends on company to company. What is the meaning of affordable? Yeah.
No, and then do we have? We'll get back to you, students. I can see many of them waiting. Last question from my side. Some robo intervention or some AI I can use in my classroom to find out what my students are actually listening and are they able to fathom the gravity of the discussion that we are having. So is there any possibility that we could use that to enhance the productivity of the session?
So there was I'll give you an example. It is live happening already. Yeah. So when you go to any car dealer, right? There are many dealers. Again, I'll not name that because I work for them, right? So there are many car dealers. They have implemented the face recognition technology. So when the customer walks in, right, and he sees the demo of the car, right? So the face recognition technology is already reading your face, right? And say, for example, the seller is explaining you that this is the feature of the car. So how your face is going away? Are you blinking your eyes? Are you making faces? So there is already an experience that is getting recorded by this technology. And when the customer walks away, at the end of the day, they see that is that customer approachable again? So they take that, now the data is available. Now the seller receives that data and he says, leave these customers because they are very negative. Like they will not buy this. Let's follow this because we see the chance of conversion there. So let's follow them first. So they go back to them, and because they know their experience was little happy when they looked at the product, wow, something wow came in their face, right? Or they said something like this. And the other one, like, this is, so they reacted something differently. So that is already happening, but can you implement in the classroom? Yes, for sure, but how?
I think though the robot thing is not there, I think that is the plagiarism check. So to what extent, students have copied from another source, that can happen. If not today, tomorrow.
Already happening, sir.
So there are e-learning softwares which are being developed, which will track their eye movement. Right? They try to see when you take e-learning how engaged you are, and they can change their behavior based on that. I heard somewhere which says there's a company which is developing a movie. What it does is it sees your eyeball movement, and based on which character you're emphasizing, story changes. Right? So story will be different for different person. But the person ended the talk with saying that, okay, if that is happening, the question is whether you are watching movie or movie is watching you.
I think it might not work with our students because our students are great dramatists and they know how to make an expression which the AI cannot catch because they are above the AI. Our students are above the AI and that's why they are the best. Okay. Implemented in the exam hall. Okay. Yeah. All right, we have 5 more minutes and we can quickly take some more questions.
Good afternoon, panelists. This is Siddhartha from second year BCom. So I have a question that let's take a situation where one of the best hackers, because newcomers may make some detectable mistakes, is creating a firewall into your software. So can AI detect the firewall while it is being made and start countering the codes made by the hacker simultaneously? If yes, and how?
Can you repeat what you're saying again? Or let me simplify for you're saying that if a hacker is targeting a firewall, can AI detect it?
Yeah, and simultaneously counter the codes.
Yeah. So then I think already AI being used for cyber attacks. I'm personally not sure how much of it modifies, but if not, that's going to be future. So AI is going to play a big role in cyber attacks, and firewall is one of the basic things that you need to take care when you're dealing with a cyber attack.
So the codes can be automatically detected and counter-attacked. They are all means the AI is also already made like that.
No, I'm not sure about the specific, but I'm sure that it's detecting as such.
Thank you, sir.
Last two questions.
Yes, good afternoon, sir. So my question is to Mr. Gulati. It is a well acknowledged fact that in case of India, we have strict or corporate governance regulations in place. And despite of having that, we are facing a lot of corporate scandals over the past 2 decades. So, and if we look into the corporate annual reports, we talk of transparency, disclosure, many things, but if we look into the reports, it is already information overloaded. So can we move to the comply or explain regime as followed in the European countries?
You have already given the answer. It is actually, you're right, because
regarding some aspect, if not for the.
No, in fact, in all the important scenario, it is important that we move to this complying explain regime, because if we keep on disclosing regime is a very good regime where a lot of information is given to the stakeholders, investors, and they read those information. Many of them don't read at all, right? So that information is always there in those reports. But if you keep I was, I think, explaining to someone only, I think the last session, there was a question that if there is an ethics matter, then what will happen? Or if there is a fraud, then what will happen? So I was giving an example on the lunch table only, that if there is a murder, say for example, some person commits a murder, what do you do with that person? You will give them a penalty of whatever best punishment is available, you will punish that person that way. So if the fraud is happening, right, or if the ethics issue is happening, you have to give that penalty or punishment to that person or an individual or an entity the best possible, because that way you will create an example. So the next person will think of doing something. He will look at it that this happened, to that person.
That will be a benchmark.
Absolutely, this has to be done. Right? There is no other way.
Thank you.
You can go to him. But then this comply and explain, we had in CSR, which was removed, and said that comply and or get fined. So if I have to comply, if I have a choice between either I comply or I explain, mostly I would like to explain in the best possible manner. So would that not allow me to, slip away?
So when I said comply and explain, I think, well, I don't know whether she also meant it like that. Comply or explain, but ultimately there is no option that you don't comply. Because practically, if you give an option to me that I can commit a murder today or I can do something theft today and I can be left off, everyone will start doing it from today only. You ask everyone, say that from tomorrow there is no penalty for theft and there is no penalty for this thing. Everyone is, let's do it. So there is no option of it, right? If you create an option, then those things will continue to happen.
Hello, good afternoon, Gulati sir, and good afternoon, Guru sir. So I have two questions. First question for Gulati sir. So regarding that ESG investment, I have a question. that recently what is happening that because of the ESG governance, the big companies like mutual funds and other fund houses, they are restricting themselves into the ESG, so they are not investing in the sinful industries. But as I have seen the interviews of Ramesh Damani, he used to say that he has made a lot of money in the sinful industries, like UBL or if you say the ITC and something. So, what do you say that we are not going to see any further that type of movement in these sinful companies anymore?
See, you've given example of Ramesh Damani. He's one of the very good investor of our times, right? So, but ESG, you have given example of ITC, and there are many other examples you have quoted. ESG as a concept doesn't mean that companies who are doing carbon emission or their business model is like that. So IT, look at ITC, like let's give an example of ITC. In most of our lives, ITC has an impression. In most of our lives, because the kind of product they produce is on everyday basis we are using, right? So can we live without those companies who are doing that kind of production? Answer is no. The answer is, can we ask them to reduce the carbon emission? Can we ask them to do the same things in a better way that will not harm the environment? That's what ESG is trying to do. ESG is not saying stop these companies. ESG is not saying that. ESG is saying that please do it efficiently looking at the future. Because the humans that are coming to going to come in future, are you leaving something for them, or you are just exhausting everything now? That's what ESG is trying to solve.
So the breweries companies, they will also come under that issue, no? ESG issue.
Which one?
The breweries companies.
Breweries companies. Yeah, so breweries companies will come, any company which will have an environment impact. So if the breweries are producing a waste which is going back to the environment, they are there. Even if there is a, say for example, diesel, even, I'll take it, let's say this in institution, there is a diesel set running. There is a waste oil that comes from the diesel. How long the diesel generator is running and how much the waste oil is coming and how you are disposing of that waste oil will define whether you are environment friendly or not. Right. So yeah, that is everywhere. So right. So ESG is trying to say that everywhere where is the fallback is going back to the environment, we start stopping that, because we will not be able to sustain it for a long. We have already reached to a point where we are seeing a lot of climate changes, right? But our future generations will not have this environment anymore to live. So we are asking companies, ESG is asking companies, please look at it seriously and start working right now, because this is the time. Otherwise, we'll maybe not have a window to work on it.
Sure, sir. Got it. Thank you. My question to Gaurav sir. So you talked about that robo advisor and in trading or so in investing, the robo advisors are used generally, but in India, how the regulators are comfortable with the robo advisors in advisory license giving or something? So are they comfortable in giving the license to robo advisors?
I'm not seeing a lot of cases in India, and again, I'm not very sure regulatory regime, but ultimately you're asking that a computer will decide where to invest, but there will be someone who's taking responsibility for that, right? You can't blame, okay, company itself will not be run by computers, right? So you're delegating a part of it to a robo, but that's acceptable globally. It's a trending thing which is coming. I'll not say it's a majority business anyway, just starting to get attention. It has its own downfall, pitfall, right? Robots will work in a certain way. They may not be able to find out some of the values of all those nuances, but it's getting more and more acceptability worldwide, and it will have small niche market. Again, we should not expect that robo advisors will replace the asset management industry. I don't think it would work like this. There will be a small sector. People would like to rely on that kind of investing as well. So opening one kind of investing avenue as such.
Sure, sir, got it. Because that SEBI is very strict about giving the license to the investment advisors, and they have to give the exams and all. So I was thinking what is should be given the chance.
Yeah, with this, we have come to an end of this second session or the panel discussion. Very, very interesting discussion we had, and I could see so many questions flowing. we had even the question whether the company form of business organization is a great form. That can also be a question because many forums are yet deciding about the stakeholders and the agency theory. Are they really working? Questions like how independent are independent directors still needs to be addressed, like we pointed out very rightly. Who will guard the guardians? That's another important, pertinent question, still unanswered. How can the board be directed by artificial intelligence, and can they really be directed? Maybe there will be a time when the board is replaced by an artificial intelligence. Perhaps we are yet to see the light of the day. A broker in United States and a broker in Bombay Stock Exchange, if you ask the same question, which stock do I want to buy? Maybe the BSE would suggest go for a blue chip. But the broker in your New York Stock Exchange would say go for cryptocurrency. Why are you talking about stocks? So times have changed. We are living in exhilarating times. Cryptocurrency is yet to see the light of the day in India, but people are still trading. We are also taxing. We are yet taxing them, but we have laws to be framed. Many questions are there. But then I think this is the idea of having a panel discussion where we have these questions and these thought-provoking questions in the young minds. I think that is the objective of this panel discussion, and we have met that in a very wonderful way. So I'm extremely honored, and definitely it has been a wonderful session, Mr. Gaurav and Mr. Lokesh. Thank you once again for being with us. A huge round of applause for them, please. My job ends here, and we have a great task that is proposing a vote of thanks, and none other than our dean. So may I invite Professor P.K. Mohanty to do the honors, please.
Thank you, Professor Vijay. I think you have done my job a bit. Good afternoon, friends. We have come to the end of another panel discussion of the day. How should I describe this panel discussion? I think some of you have already said insightful. I think you said insightful. I think I should describe this as highly informative as well as educative. The kind of discussion we had on artificial intelligence and corporate governance is really has given a lot of knowledge, and also we started this discussion. If I remember correctly, Professor Vijaya said we should invest in finance, not only knowledge. We should invest in finance and knowledge. I can modify that a bit. I can say that let us invest in knowledge, finance, as well as technology. Because a lot of technological issues have been discussed. Artificial intelligence have been so nicely. So many technology-related issues have been discussed by our experts. If I take Mr. Gaurav's viewpoint on artificial intelligence, you have nicely explained about the role of AI. And the question also arose, how much AI? Is too much AI bad, good? So it's up to you, because the same question was addressed in another way, another form, like, did ATM take away jobs? In fact, another question was coming to my mind when I was in college. That time, banks were going for computerization. And I remember there were lots of hues and cry. People were up in arms. No, if we start computerization, we'll be losing our jobs. Rather, in fact, what we also discussed today, it has created more jobs. So technology doesn't take away jobs. Technology rather simplifies our jobs, and it creates more jobs. And as human beings, we should have the required skill set to make a difference between the machine and, because machine also requires somebody to guide them. As pointed out by one of our experts, you have to know the functionality of a particular thing. Machine will do whatever you program, but who will do that programming? the human mind will do that. You also talked about your discussion on reconciliation of AR, accounts receivable. It caught my attention. I know how difficult it is to reconcile accounts receivable with control accounts. So if AI does that, it's a wonderful thing. And auditors are also using artificial intelligence to do the sampling. How much to audit? So the sampling technique is also done by the artificial intelligence. Risk management and many other things are done by the artificial intelligence. So artificial intelligence is blockchain technology. They are going to be the order of the day. We cannot escape this artificial intelligence and machine learning. It will affect our lives in some way or other. Now coming to Mr. Lokesh, talked about governance. You talked about the issues and challenges about talent retention. And about talent retention, I think we have reasonably adequate discussion on talent retention. And Madam also gave very nice ideas about the egg freezing and those things. One thing was coming to my mind about moonlighting. You know, HR people are also going to examine this issue of moonlighting. It has come, I think today's paper talks about TCS is going to engage its HR department to examine this moonlighting issue. Because if hybrid mode of work culture has started and it will remain, because you may be aware that the software companies have come out with the 25 by 25 concept. By the year 2025, only 25% of the workforce will come to the office. Rest 75 will be working from home. So you cannot just stop this moonlighting. I have been reading. I was not knowing what moonlighting is. Let me be very honest. So when this thing came up, I was reading many literatures about moonlighting for and against, of course, and the views are more in favor of moonlighting because you cannot stop that. After working for 8-10 hours for a company, I am free to do whatever I want. So moonlighting may add another feeder to the HR. HR people are not there. You also talked about ESG. On ESG also we had a fairly good discussion. This ESG are adding another dimension to the way we are going to do business. You also talked about April, the finance minister, talking about we are coming back to coal. Since you said yesterday, I thought you are referring to something else. Yesterday, our finance minister has said, rather, it is quite interesting. Our finance minister has said, rupee is not declining. It is dollar which is strengthening. So that is another way of saying that rupee is declining. So yes, question about independence of the independent directors. How independent the directors are. When we talk about true independence, a lot of things are yet to come. A lot of framework have to be made. But another point I would like to add here is we talked about the women representation in the board. I have read somewhere in the recent past that though it is mandatory, 2000 Companies Act 2013 has made it mandatory to have at least one woman director in the board. Many companies have not yet fulfilled that. Have not met that criteria. So we have a long way to go. Laws are there, but again, checks and balances have to be ensured. Again, coming to your another point, trust and transparency. We are doing things in a transparent way. We talked about the annual reports. When I tell my students, when I teach accounting, I tell my students to go through the annual reports of companies. And long back, when I was a student, when companies were preparing their annual reports, which are of 30, 40 pages, TCS, not TCS, Wipro was the company whose annual report was highly voluminous. It was, that time it was 300 pages. So that means lots of disclosures, lots of information they want to share. So this brings me to another point which my colleague Professor Uchati raised. Is it not information overload? But if information is not there, how to deal with that? So whatever information you look for, I will not be looking for that information. So yes, transfer we have to do. I mean, corporates are doing doing business in a transparent way, but trust is something that will keep the investors and other stakeholders remain glued to their business. So with this, I would thank profusely to our two experts, Mr. Gaurav and Mr. Lokesh, for sharing their thoughts on these two important topics. They have described, they have given their thoughts, they have shared their viewpoints in a very nice manner, which you all have enjoyed and have learned something. I must thank my colleague, Professor Vijaya Bhatt, for moderating it in a very nice way and also adding many points to the discussion. I thank my faculty colleagues for participating in this panel discussion. And this discussion is for the students. Not only for students, for us also. Let me also say that I have also learned many things. So the students, the way you have participated, the way you have raised questions, that talks a lot about your involvement in this discussion. Thank you very much for organizing this business conclave. Thank you for your time. Thank you for your understanding of the subject in so very detailed manner. And I also would like to thank all the organizers, all the people who have worked behind the scene to make this business conclave a success. Thank you very much.
I would now request our Dean, Professor Dr. Pradyum Kumar Mohanty, to felicitate our esteemed speakers by presenting a small token of appreciation. Although this marks the end of today's session, we hope to continue with the same enthusiasm and thirst for wisdom for tomorrow's session. Please join us tomorrow at 10 a.m. for the second and final segment of Privitti 22. Thank you.
All the students are requested to wait. Please settle down.